Right, I think everybody is in already, and good morning from the BCI team, and welcome here to the capital in Pretoria, where we have a live session. This session will be recorded today as well, and we are going to share this recording with you afterwards, as well as all the presentations you are going to see today. We've had a lot of questions yesterday, good content coming through from our presenters. Will we get the presentations? Yes, you will. There is some really good stuff in there you can use for your clients as well. Before we get the proceedings underway, maybe just a quick few house rules. CPD points, if you want CPD points, make sure that you've registered, you scanned in, and very important as well to scan out again once you leave the venue, once we've done here for the day. Cell phones, if you can put it on silent, we really appreciate it. It's not a webinar, so we are going to be able to hear your cell phones. The QR code on the screen, if you haven't scanned in yet, you can maybe do that now. Anybody else there? Nobody's scanning in, and then we can actually flip over to the agenda. The agenda behind me for the day. The BCI team made a really good effort to get some top investment minds here for you to make sure that we provide you with useful information to guide and assist you when constructing or reviewing client portfolios. We encourage you as an audience to ask questions to any of the panelists. We are going to allow for probably about 5 to 8 minutes after each session, after all the presentations is done, so you can ask questions. We've got a roaming mic in the audience. Since we are recording, we want to ask you that if you have a question, maybe try to get the mic. If you don't have a mic with you, give us a question anyway. We'll just repeat the question and get you some answers on that. Right. The Fed, once again, warned of inflation to the upside. So it seems like inflation's with us for longer, and definitely higher interest rates as well. That's got an impact on all asset classes. I'm going to have a look today in terms of what that impact is. With the US 10-year yield still going up, surprisingly, so that is an indicator that rates are probably going to stay longer for a lot longer. Narratives over the past 18 months have all been wrong. We've seen our forecasting and what the market thinks is going to happen to certain global macro events has been very wrong, and you can name several of as examples over the past 18 months. Point being rather is that we can't forecast. You're going to hear that today from the presenters as well. Forecasting doesn't work. Even if you get forecasting perfectly right, it's then about how you apply or how you go into the market and how you apply that to specific portfolios or mandates. Much talked about China. Beginning of the year as well, how the unlocking of China is going to be beneficial for emerging markets and places like South Africa, but that dissipated very, very quickly. And we've seen now the Chinese real estate market into a real crisis. Yes, there's been some stimulus coming to the fore, but maybe not enough. We're going to see a lot about that today as well. The impact of China, where China is going, and what that means for things like South Africa, like resources, emerging markets, equity markets. But a little bit more about that later. They've got a lot of great plans in terms of how they're going to implement fiscal stimulus, but very much like South Africa, a lot of great plans how to uplift our economy, but it's still just plans on paper with very little action. Year to date, there's been massive momentum in tech stocks. Maybe more so the Magnificent Seven. You've all heard about that. I'm not going to explain to you who they are. No, they're not cowboys. Maybe they are cowboys. But that momentum really seems to stick, much like a suspended public protector sticks to office. He just doesn't stop, right? Fiscal stimulus in the US and excess savings of US consumers kept the US economy going for, I think, a lot longer than one would have thought. But are they running out of runway? Is that excess savings starting to dry up? How much room does politicians in the US, especially a year before elections, still have to provide certain stimulus packages into the economy, especially if they're still very hawkish on inflation? We'll have to see. The property market is normally a good indication of an economy's health, especially if you look at something like SA. We know that SA REITs in the property market and property shares has been under a lot of pressure, and so is our economy. I mean, GDP is just about flat. We're going to have to wait and see, what's going to happen to that and what that means exactly for things like SA or local equity. Nevertheless, the SA property market, given all the headwinds that we've experienced over the past 18, 24 months, showed significant resilience. And if you look at property valuations at the moment, it looks to be very, very attractive on any matrix that you would want to look at that. With that said, it's my absolute pleasure to welcome our guest speaker for the day, Andrew König, Chief Executive Officer of the Redefine Property Group. Good morning, Andrew. While he's coming to the front, Andrew's got more than 30 years experience in commercial finance, and he was appointed as Financial Director to the Board of Redefine Group in January 2011 and Chief Executive Officer in August 2014, and have since taken that group to new heights. Andrew, thank you so much for your time this morning. Really great to have you here.
Thank you, Eugene. Good morning, everybody. Eugene has actually made my presentation easy in that he's already covered all the points that I wanted to cover. But I will delve into a bit of detail. But before I start, I just want to highlight the point that all the bad news has already been priced into the SA REIT sector. In fact, we were quite surprised that every year since the pandemic, we thought things couldn't get worse. They did. The market similarly priced that in. But we do believe we're now at an inflection point where we can start looking for the upside. And through my slides, I'll give you anecdotal evidence of those so-called green shoots that we are starting to see. And yes, we are opting for the upside when we say that there is cause for optimism in the SA REIT sector. And I think just generally from a South African perspective, we can similarly also start looking rather for the up rather than the down, as we are so accustomed to and programmed to do. But having said that, despite all the challenges during 2023, the SA REIT sector has demonstrated remarkable resilience. The overlapping aftershocks of the pandemic have been absorbed. They've also been adjusted for in our portfolios to consumer behavior or tenant behavior that has changed. Elevated inflation, yes. Here in South Africa, we're quite used to it. Elsewhere in the world, a hell of an unknown for them, in that most people, they've never seen this in their working lives. But it has been absorbed into our cost base. And the good news about inflation is that we are seeing lease escalations responding accordingly. As you know, retailers in particular were public about beating up landlords in terms of escalations. Now, the tide has turned, given that inflation was their primary argument for the lower escalations in the rental agreements. In terms of the energy crisis, which we're all very familiar with, it has presented significant investment opportunity for the SA REIT sector in terms of our rooftop space being used for solar PV. I'll talk a little bit about it in due course. And then clearly higher funding costs are still a feature in the sector. It will take time to absorb and work off the current effects that we have seen. And in 2024, it will be, unfortunately, a negative feature of the REIT sector as these effects play out. In terms of tight financial conditions, the big move to ESG has finally started bearing fruit in the form of green bonds, broadening our funding sources away from the traditional banking typical debt arrangements, and we're seeing more and more of those coming through. So just moving on, in terms of the prosperity of commercial real estate, you'll see that the fundamentals that we need to look for would be solid confidence, predictable interest rate expectations, economic growth, and constructive capital investment. I'll be touching on all four today to demonstrate to you why we believe that we are poised for the upside in the property sector. In terms of solid confidence, as I said earlier, South Africans, we are programmed to look at everything negatively. So this morning, I just want to remind all of you that we need to just take stock of what we've got here in South Africa, just to remember there is reason for us to believe that the future is positive from a confidence perspective, especially with an asset class that one should take a long-term view on. South Africa's constitution, as we know, is progressive, and we have an independent judiciary. It has come to our rescue on many occasions in the past few years, as you know. Eskom's restructure although it's going slowly, although there's still bureaucracy and red tape, despite what the Minister of Energy likes to tell us, we are moving slowly, but in the right direction. You would have seen, for example, virtual wheeling coming to the fore. The reason for that basically is to bypass all the bureaucratic blocks along the way from municipal authorities, which is a significant step forward for us. Municipal collapse is something we live with on a daily basis. We're saying, despite what we're dealing with, it's a good thing we're at that point. Why? Because private sector is starting to step in where there is spaces, where there is situations that are not being addressed, such as private firefighting. The Reserve Bank has done a great job in terms of managing our inflation compared to other countries, especially emerging market ones. I think we got off lightly, but it once again speaks to their independence. As unpopular as interest rate increases are, they have stuck to their guns, which is great. And then in terms of government and organized business, for the first time in, I think, ever, since democracy, we have at last got to a point where government is embracing organized business to assist with this, resolving obstacles for economic growth and job creation. And you all know about the priority interventions covering the energy sector, transport, logistics, as well as crime and corruption. In terms of predictable interest rate expectations, Eugene, I know, spoke about it, and he's right. Inflation may be here for longer, higher interest rates may be here for longer. But if I just look at what the banks are telling me, and they are far more informed than we are, and we always say that with banks, we're dealing with fixed odds casinos here, so they know more than we do. But if you look at the swap rates, whether it's in Johannesburg from a JIBAR perspective or whether it's in Europe from a Euribor one, you'll note that the 5-year swap rates are not going upwards. Yes, they are sticky, but they're not going upwards, and I think that is a very, very important cue to take, that interest rates are, if not at the upper end of the cycle, but very close. Perhaps Europe has got a bit of a way to go because their inflation is lagging the rest of the globe. But certainly here in South Africa, I think we're seeing encouraging signs that the interest rate cycle has peaked. In terms of our economy, I think everyone in the room will agree with me that they've been wrong-footed repeatedly during the past few months, when we've all been calling recession and all sorts of negative headlines, and we seem to be dodging it despite our best efforts to put ourselves in a recession through energy and infrastructural headwinds. So the good news here from a real estate perspective is, yes, if you have a look at the rental reversions, they are negative. However, they're not getting worse. They have stabilized. And this is very, very important for us for the long term. The bad news, as I said, has been priced in, and we believe now we are at that trough. And here's evidence thereof. And as you can see, escalations are holding firm, back to my statement around inflation assisting us in those negotiations. In terms of the South African REIT sector, you'll see that 76% of our collective asset base is exposed to retail and the office sectors, and that's why I've chosen those two sectors on this slide. But what you'll see here from a retail perspective is that occupancies are now stable. The retail rentals, as you can see, are not stretched. They're currently trending at about a rent-to-turnover ratio of about 8%. If it goes over 10%, then get worried. So we've got some headroom there. And you'll also see from an office vacancy point of view, very ugly on the eye. As you can see, circa 16% vacancy. However, it's not getting worse. In fact, more conversations I'm having with managers, CEOs, and so forth, is that they are demanding staff to return to the office. Also, we know there's a hybrid system in play where there's 3 days at the office, 2 days at work, and we know the default is Mondays and Fridays at home. You need an office for Wednesday to be fully staffed, because that seems to be the trend, and that seems to be propping up the occupancy levels. In terms of activity from an office point of view, you'll see that it's tapered off significantly. That's good news. We've been dealing with an oversupply of offices with no new tenant demand, and this signals for us that the irresponsible development activity for now is over, thanks to the interest rates mostly, but similarly as a consequence of of an economy that isn't creating jobs. In terms of financial health, in a post-pandemic environment, the REITs have really worked hard at building strength into those funding structures to create them a more sustainable funding base. The good news is that valuations have stabilized. You'll see that during the pandemic, and slightly thereafter into 2021, we had a lot of negative valuations. Valuations aren't shooting the lights out in terms of bouncing back. However, they're not sliding further backwards, which is the encouraging take out from that slide. And then the REIT LTV ratios, we've always used that as a measure of, how strong is your balance sheet at 37%. Pretty good. Above 40% is where one should start looking carefully. And you'll look at the hedges at the moment in place. Roughly 64% of the loan books are hedged. The reason for the drop-off, it should really be long-term around 75%. The reason for the drop is principally because you don't want to bake in the pain at these high-level interest rates, and a lot of the guys are floating for now just to ride out this current cycle. More importantly is the interest rate cover ratio, sitting at just over 3 times. Bank covenants generally are between 2 and 2.5 times. At 3 times, you'll note that in this environment, that's probably the most measure of financial health from a REIT perspective. Just looking at constructive capital investment, we can all conclude that the state isn't going to come to our rescue. Private sector will step in where there is state inefficiency. We've seen it over the years, and I've listed there for you a number of public services that have failed, that have been replaced. I'm sure you can add to this list. I did this on a Sunday afternoon and I ran out of space on a page. I'm sure you guys would come up with many, many more alternatives and examples. And I think that the next transition, and the very, very crucial one, is dealing with energy, the ports as well as railway, because those three, if sorted out, will give us a GDP boost of about 3.5%. You'll see the rooftop structure there is a Redefine property. It's Mall of the South. It's the 3rd largest rooftop solar PV facility in Africa. And everybody's doing this who has not only the access to funding, but also the rooftop space to generate principally for own use at this point. In time to come, there will be wheeling, which is supply into the grid from these facilities where there is excess capacity. The ports we know have been privatized, are being privatized, with the Durban port in this picture being the one recently announced to the Philippine organization, and then Transnet and Prasa being, I think, our biggest challenge at this point in time, in that there's still a lot of thinking going on, but not much action at this point. In terms of the REIT sector, unfortunately, I don't have statistics from a sector perspective on a socio-economic level. I can just talk about Redefine because we did a study about a year ago. Our local portfolio is about 59 billion rand. Around 41% is invested in retail. We created 12,850 jobs, of which 55% is in retail. So what this slide demonstrates here is that in a consumption-driven economy, the impact retail has, which, by the way, 62% of the property sector is invested in, and how it creates jobs. So this was Queen Square in Little Falls on the West Rand, developed at a cost of 216 million rand. During construction, we employed 641 people. Today, we have 27 stores generating a combined annual turnover of 330 million rand, and we've created 439 permanent jobs. This is just but one example of one small property in the sector, and you can see the impact it has on the greater society as well as the economy itself. Just looking at the real estate sector for a minute, it is offering compelling value. If you have a look on a historical basis where we are, my slide says double-digit returns are expected. I can say that with confidence, and I'll just use Redefine as a reference point. If you invest today in a Redefine share, you'll get a dividend yield of just under 14%. That's before any potential capital uplift. There are many other counters in a similar position, as you can see. And for those of you who are far cleverer than me, I'm sure you can spot there's an opportunity on the yield analysis. When those bond yields start dropping, you can switch into the REITs, and there you go. You're going to get a double hit upwards to your investment. In terms of the sector, from a pricing to NAV point of view, there's this constant debate. Is our valuations wrong? Was the market wrong in terms of the pricing? We believe maybe somewhere in the middle is the answer. We are still at a deep discount to the share prices. As you can see, currently we're in the region of about a 40% discount to NAV. In terms of the REIT business the REIT business model, you'll see that it's now far more sustainable in a post-pandemic environment. And there are certain attributes that will differentiate one REIT from another. Those that have exposure to assets decoupled from local fortunes will have a buffer for what's happening domestically while we sort out our economy and all the other challenges that go with it. We have introduced a dividend payout ratio between 75%, which is the minimum that you can pay out, to about 90-odd%. As a consequence, balance sheets have been strengthened. We've demonstrated during the last 4 years that management teams have been great at coping with structural shifts. We've adapted. Our balance sheets are better managed than they've ever been before, and portfolios have been cleaned up. So generally, there's a flight to quality. So those assets that are in good locations, they are efficient, and they are green, will definitely attract tenants. In terms of those asset platforms with interest in NATO countries, you'll note that the economy in those regions is bouncing back significantly, and those REITs that are exposed to those countries will reap those benefits. Just lastly, this slide I put in to give you an indication where we believe the REIT sector finds itself. And if you have a look at it, we honestly believe that we are in the trough of the cycle, and we are at about 5 o'clock, depending on whether it's AM or PM is irrelevant. But for us, this has been almost a career-long cycle. Real estate is a long-term asset class. I just need to remind you of that. And this trough will take some time to work off. We've been through most of it so far. And we believe that by about 2024, this time next year, we should be in a far better position as interest rates start cooling off. So with that, I'm going to thank you for your time. And if you have any questions, welcome to take them.
Any questions for Andrew? Yeah, got a question right here. Mic coming to you.
Thank you. Morning, Andrew.
Good morning.
My name is Akua from Equitas Property Fund. Sorry that your first question has to come from a competitor, but it's very general. You mentioned that everything bad has already been priced into the sector, and I'm just curious on your thoughts about obviously the upcoming elections next year, and whether you think that's been priced completely, or if it's too kind of like far ahead to consider that at the moment.
Look, I think real estate's a long-term asset class, and we look at all sorts of risks. Unfortunately, we only manage the variables under our control. How voters vote is uncertain. Yes, clearly, there is always a concern around how would a potential coalition government work. But for us, it's more about managing the variables under our control. All of us here have to live. We have to work. We have to function normally, and that is what we provide. So we're not distracted by the elections. Yes, it's going to cause a lot of noise in terms of potential disruption of services, potentially, community upheaval and so forth. And those are things we just have to work through. We're just going to carry onwards and upwards. So.
Can we just get a mic here in the front? Sorry. Thanks, Tanya.
Andrew, good morning. JB Bloch, PSG. When you do transactions, and I know the shares at a deep discount, when you do a sale of property, for instance, do you sell it at a deep discount or close to your NAV?
So that's an important question, because You know, we're always challenged by investors with this disconnect between NAV and share price. We've been transacting at book value. We haven't been commanding massive premiums, but similarly, no discounts to book value, which strengthens our argument that our book values are right, because that is the true test of value, is when you actually independently transact with a third party.
Right. Great. Andrew, thank you so much for coming through. It's been a great privilege to have you here, and thank you for your time. Thank you. Right, our next session on local equity. Local equity looks cheap in any metrics that you look at local equity relative to its own historic history, and especially if you look at SA equity relative to global markets. Is this a time to increase exposure to really well-priced opportunities? Well, we'll have to wait and see. We've got a great panel here for you today. Welcome to the stage now is Tumi from 361 Asset Management. You can come up so long if you want to. Sanelisiwe from All Weather Capital. Ofri from Visio Fund Management, and Barry from Investec. You can all come to the front if you're ready. Tumi, thank you so much.
Thank you. Morning, everyone. I always get asked about what our name actually means. We're in Pretoria, and the first time I heard us being quoted as 360 was here in Pretoria. We are not 360 we are not 36-1, we are 361 Asset Management, and it's all about challenging conventional wisdom. It's about that extra degree of difference in terms of our research, in terms of the service we provide to our clients. 361 manages just over 40 billion in AUM. We've got around 12 investment professionals that look after our hedge funds and our unit trusts. What's nice about 361, we always talk about our hedge fund thinking. And I think our hedge fund thinking not only benefits the hedge funds, but also permeates across all the long-only funds and unit trusts that we manage in terms of thinking about what we also don't want to own. Before I go through our actual positioning, I'd like to touch on a few macro considerations that we think are quite important to think about in this equity environment that we're positioned into. The first thing, we've seen the World Bank and we've seen a number of the big organizations like the IMF downgrade their global growth estimates. And just to put it into perspective about these downgrades, we're seeing sort of the slowest pace that we've seen in terms of growth over the last 3 decades, only being overshadowed by the global financial crisis and the COVID pandemic. So quite a slowdown in growth. If we look at the top global manufacturers, you've got the US, there we're seeing quite a significant deterioration in terms of your manufacturing numbers. Your order volumes are falling even faster than your factories are actually cutting production. In Germany, which is the largest Eurozone economy, we're also seeing a contraction happen. I mean, they just reported some of their factory order levels yesterday, and people were estimating around 4.5% decline in your factory volumes dropping, and we're seeing almost an 11% drop in some of these factory volumes. So Germany also in contraction territory, same as France. And what we're starting to realize is that firms might need to cut production further to manage all these order volumes in the near term. What we are seeing in terms of inflation, so yes, commodity prices have moderated, your supply chains have eased, but if we look at core inflation, which excludes food and energy, this has also proven quite sticky. For us, top of mind has been labor inflation, so we're keeping on track of what's happening in the labor markets, particularly in advanced economies, because these labor markets have remained very, very resilient. So yes, job growth is slowly starting to slow right now, but if we look at wage gains are still above pre-pandemic levels, so that's a little bit concerning. What is happening on the company and wage front? They're still trying to backfill a lot of their shortfalls, and they're also trying to respond to demand. So you're seeing still quite significant increases in terms of your wage gains. And for us at this point of the tightening cycle, we would have expected some form of employment softening, but we're not seeing that yet. So for us, it does definitely mean that the monetary policy may need to remain higher for longer. But what's positive over the last 2 weeks, your job growth numbers have started to slow. We are seeing a bit of slight slackening in the labor markets. So there's been a bit of, in terms of your direction of your data, it's actually at least traveling in the right direction. If you look at the US 10-year, this has started to spook investors. It's above now the 4% level at around 4.25%. What's caused the spike in your US 10-year? So we saw Fitch downgrade the US debt. That was quite a shock to a lot of people, even after the debt ceiling saga. We also saw the US Treasury demand pick up in terms of what the debt sales that they wanted to take place. They were looking at around 103 billion in terms of the debt sales that they wanted to put through in the market. They're really testing demand there. So the US Treasury Department is also spooking investors in terms of the debt they're trying to put into the market there. And also investors and market participants are very concerned as to what's happening in terms of this potential slowdown. I mean, even when I showed you that manufacturing, your PMI is coming down, your services, which has also held up quite nicely where people were traveling, there was entertainment, that's also starting to slow down and coincide with your manufacturing slowdown. So people are quite nervous as to the potential slowdown in the economy. For us on the US 10-year, we do expect it to slightly see a modest declines, particularly at the beginning of next year. We don't expect it to go down to the 2% mark, but we are expecting sort of a slight slowdown in terms of your US 10-year treasuries. Then, I can't speak about equities without touching on what's happening in China at the moment. Quite a lot of questions we had yesterday on what's happening in the real estate market, because you saw quite a huge tick up in some of these Chinese development properties, slowly starting to tick up again. But from my perspective, if you look at the Hang Seng Property Index, you've seen such a huge decline in the property index. So even if you are seeing a bit of a recovery, it's more people that are being speculative and are trying to estimate what's coming in terms of the stimulus that will be provided by the Chinese authorities. If we look at the property and what's happening on the real estate market, for us, it's still extremely concerning what's happening on the Chinese front. Chinese developers have seen almost a 33% decrease in terms of their sales that have taken place. And the 33% decrease year on year was already on a suppressed base last year. So quite huge declines happening. People are estimating even further defaults to take place in the real estate environment. And what we've seen, how it is also impacted individuals and high net worth clients. Your high net worth clients have also decided to start paying off a lot of your mortgages quite early. Last year, we saw almost 14% in terms of your entire country mortgage balances being paid off by individuals in China, just being concerned about what's happening in the real estate front. Here, I'm starting to show you just your home sales, the declines, and your housing starts, quite significant declines just there in the real estate environment. And just to put this into context, your real estate makes up almost 30% of your Chinese GDP. And China is such a big part of the global economy, you can just imagine how big the real estate is in terms of the global economy. If you look at the Chinese financials index, you saw a slight tick up there. So everyone was sort of preempting what's going to happen on the stimulus front in China. You had people also trying to dig deep and read what's happening on those Politburo submissions and seeing how much stimulus is going to be applied, because we know the economy is weak there. We know that manufacturing is also slowing in China. What's going to be happening on the stimulus front? And everyone's been keeping track of what's happening in the stimulus front. So you are seeing people sort of preempt what's happening in the stimulus, but everyone is still saying they aren't as aggressive as they should be. Yes, the stimulatory measures have gone from prudent to more stimulating in terms of the economy, but they're not as aggressive as they can be. They are trying to reduce the lending rates, but is it doing enough in terms of the economy? We don't think it's doing enough. Then you've got the imports share. If you look at US imports and if you look at China's share, this has dropped by almost 24% year to date. So quite a significant drop in terms of the US imports that are taking place. If you look at it even over the last 5 years, you're seeing a 10% decline in market share. Okay, so China's dominance in terms of the number of imports and exports that they're taking from their country is slowly starting to slow. Yes, they're getting a bit of increased competition from Vietnam, from Mexico, from Thailand. These countries are seen as very small in terms of size, also very small in terms of their infrastructure versus China, but they are giving China a bit of competition, and they are challenging China in terms of their market dominance in terms of this import front. Platinum, if we look at platinum, the whole thing with platinum for us has been EVs. We've been glad to have not owned platinum this year. If you look at your palladium and rhodium, you've seen significant declines in palladium and rhodium as your EV penetration has ticked up. So we haven't owned this in our equity funds, and we've been good not to own this. The only concern for us here on the platinum front is what then happens to South Africa in terms of trade. What is happening in the current account surplus? We are seeing a negative trend in your current account surplus. Your total tax revenues are coming down in South Africa. We know that a lot of the platinum producers export most of their production. So for us on the platinum front, it's not only the EVs that we're keeping track of, we're also keeping track of South Africa's current account and what's happening in the terms of trade. If you look at South Africa, and we were to exclude tech stocks and exclude dual-listed shares, you can see over the last 15 years that South Africa hasn't grown. So for us, it becomes extremely important, if we are going to trade on these shares, to be very tactical, to not get stuck in value traps. So for us, it's extremely important to dynamically manage what sectors do we want to be exposed to at different points in time in terms of the entry price, in terms of your margin of safety, because we're in a constrained environment and we haven't seen growth in a number of years. I also can't talk about South Africa without talking about the increased load shedding that we are seeing. This load shedding, just when we think it's improved, I mean, a lot of South Africans, yes, are very negative, but when it comes to load shedding and any form of improvement in load shedding, you do see a lot of South Africans get a lot happier. Even on our calls, we have daily investment calls. When the load shedding is better, everyone is a little bit more happier. But just to highlight some of the load shedding effects that we're seeing from Ramokgopa, who's the electricity minister, he's highlighted quite a significant hit, an additional hit in 2023 to your global economy. He's estimating it around 400 billion rand. So significant effect of this load shedding on your economy. We're seeing a 77 billion rand to your tax rates in terms of your tax revenue, and also a hit to your job numbers. They're estimating around 860,000 rand hit to jobs employment. I'm not going to go through this, but this just summarizes our macro views. Yes, we're concerned about what's happening on China. We are expecting a few rate cuts to take place in 2024. We are expecting that global inflation will base itself. Looking at our current positioning, just to show you, 361 is quite dynamic. Given our size, we are able to independently move from different allocations in your sectors. Here, the biggest decline in our sector year on year has been resources. We've been very concerned about what's happening on the global growth environment. I spoke about the platinums that we were quite nervous about, and we've been happy not to have owned. So resources has been the biggest decline in terms of what we're seeing. We are seeing a slowdown in demand just in terms of PGM, coal, iron ore. So that's the reason why we significantly underweight resources year on year. Another one that I'd just highlight there is tobacco. Tobacco has performed well in 2022. It was a little bit of a disappointment in 2023, but for us, from a longer-term basis, we're looking at what's happening on the new generation products, your new vaping products, how those are going to be penetrated into the market, especially as they hamp down on the illicit vaping products in some of these regions. So we're quite constructive on tobacco on the longer term. This just highlights our sector over and underweights. You'll see British American Tobacco come up there. On the banks and a lot of the financials, we've just decided to rather pick certain banks that we like. We've taken profits sort of in the standard banks. We're now overweight ABSA. ABSA had derated significantly to around the 150s mark. Everyone was worried about what's happening in Kenya, with Kenya potentially defaulting on the Eurobond next year. But we were quite constructive on that with the support from the World Bank. So we actually took that as an opportunity to upweight our ABSA weighting. This just highlights our top 10 Rand hedges versus SA Inc. We still overweight Rand hedge stocks versus SA Inc. Because of that constrained environment that I mentioned. We do like a lot more of the dual listed and Rand hedge stocks for the portfolio. Last slide, just our performance. So this highlights just the local equity. We've excluded the hedge funds here. Local equity performance year to date and our multi-asset funds. I'm one of the co-managers on the multi-asset funds, the Reg 28 and the flexible fund. But this just highlights our performance summary. Thank you.
Thank you, Tumi. If Sunny, if you can come up, yeah, next.
Right. Morning, ladies and gentlemen. I am Sanelisiwe Tofile from All Weather Capital. I wasn't expecting to go through the meaning of our name before Tumi started talking about what 361 means, but I think ours is quite self-explanatory. All Weather Capital, we hope to manage, clients' money through all market conditions and, hopefully invest in producing positive outcomes for everyone. So I think that's kind of our overarching theme and what our business is about, and that kind of feeds nicely into our purpose, where we believe that our passion must improve people's lives, being the underlying clients, being the society in general and the country. So we do that by generating meaningfully better returns, continuously engaging companies on ESG and other kind of corporate social governance issues, helping them to transform as well, and then giving young black people a chance to get into our industry, which is quite an attractive, lucrative industry to work in. So I think that those are kind of the three overarching kind of reasons, I suppose, other than performance, for All Weather to exist. We are now in our 10th year of operation. We'll be celebrating our 10th anniversary in May next year, I believe. So All Weather's been around for 10 years. We've got a pretty good track record across all our benchmarks, and we're quite proud to have survived for 10 years, because not many businesses do survive for that long. And kind of put this ad on the paper as part of that celebration, but also as a way of kind of recruiting new talent as our business is still growing. And you'll see on the next coming slides, where our AUM sits and the likes. With that, I suppose we do still fit quite nicely into the boutique space, sitting about 20 billion of AUM. And that's covered sort of mainly by the equity products, but we've got sort of hedge funds at about just less than 2.5 billion, and then our James products also roughly 2 billion rand, 106 million US. So those are the kind of the mainstay of our business. And we've got smaller kind of funds in our global hedge fund, some balance products, and the property fund as well. Those are quite small though. I won't run through this in quite much detail. This is just a slide representing our team. You can see it's quite a diverse team, good amount of experience as well. Similar kind of themes running through in our ops and our kind of client engagement teams. Good experience and also good sort of diversity, and we do have quite a strong focus on trying to bring ladies into our industry, which we believe is something that is quite sorely lacking. So we're quite proud of what our team looks like at the moment. So I think the theme, of this presentation, of our presentation, as Eugene highlighted earlier, we've got a situation where, local equities look quite cheap. And the debate, I suppose, is the right time now to come into sort of local equities and buying local assets. And I think a natural starting place is to kind of go at a high level global asset allocation. And you would know from the past 10 years, the world has been very US-centric. A large amount of capital has moved into US dollars. 62% of the global equity market cap is the US, which is a big kind of over-indexation relative to the to the real economy, where they only represent about 25% of global GDP. So the question then becomes, is it the right time? Is it perhaps the time now for capital to start moving out of the US and back into EM, and I suppose as an extension into a place like South Africa? I suppose an additional point to mention is that for the past, I suppose, couple of decades, the so-called baby boomers have been building up a nice sort of capital base. They are now the single richest cohort in the history of, I suppose, kind of human knowledge, with sitting at about $70 trillion of wealth amongst sort of the so-called baby boomers. So that's a big amount of capital that we believe either needs to kind of be repositioned and is going to be a bit of a headwind for the US as these baby boomers kind of draw down, their capital base, with an average age of about, I think the number is sitting about 58 years or close to 60 years old now. So we have developed, as a team, the way we look at the macro. We are a bottom-up house, but the way that we've looked at the macro is that we've developed these what we call these investment dashboards for each kind of major region. So we'll have one for the US, you'll have one for EM, you'll have one for the local part as well, and I'll show you each of those in turn. But I think the point here is, as I've said, it's about looking at how over-indexed the US is in terms of market cap and how much demand and growth you've seen in the US market, representing 62% of the global market cap. As you filter that down, you can see that the gems are universe, and really all the other parts of the market are the inverse of that. They're somewhat under-indexed, with gems being 30% of global GDP, but only 11% of global market cap. China 18% and 3% respectively, and South Africa is a very small 3% of gems, and obviously South Africa is a beneficiary into kind of any EM flows. So looking first at the US kind of dashboard, I'll only touch on a few points here, but I think the main thing to look at here, we've color-coded these on a timeline. So this is kind of a one-year timeline at when we started it, but obviously we kind of need to roll it over for our next quarterly strategy session. But as it sits right now, what we've got is a situation where you've had quite a few tailwinds in certain parts of the US economy. So, all the green parts there, which benefited the US economy with fiscal policy, running big deficits. You had the COVID-19 kind of stimulus still being spent by the US consumer. That's kind of benefited the US equity market as well. And you've had monetary stimulus, or monetary policy rather, which was quite friendly and supportive, but now it's become restrictive. And then, passive investors have been benefiting any sort of the larger indexes. So it's a very kind of self-reinforcing cycle when it comes to passive investing, which has benefited the US. So we believe, some of these themes are likely to reverse because we've come to a point where, if I just tap to the next slide, where the US has become quite expensive. So this chart here just shows you two things. It's the PE relative of the rest of the world relative to the US. So when that line moves down, it means that the US is becoming more expensive, or reversely, the rest of the world is becoming cheaper relative to the US. And you can see this chart is about only 20 years, but you can see it's actually come down to quite, the lowest point throughout the history of that chart. So you can see the US is quite expensive relative to the rest of the world. The chart on the right is just the dividend yield. It shows you kind of the similar thing, but the point here being that the US has become quite expensive relative to the rest of the world. We spoke about the Magnificent Seven earlier, and this chart just kind of shows you from year to date, the S&P is got a positive return, but 90% or 85% of the positive return comes from these so-called Magnificent Seven shares that Eugene was mentioning earlier. You can see that the blue line represents the rest of the S&P, which has actually been flat for the year. So a big part of that growth has come from these tech companies. If we move to the kind of China dashboard, again, similar theme here, but I think there's a few kind of factors that we believe are likely to benefit China, but it's not going to be a big sort of high-level kind of benefit or high-level stimulus, because now I think the Chinese government has moved to a strategy of stimulating certain parts of the economy. So it's not going to be infrastructure-led anymore. You're going to see growth in certain areas like consumption, mainly consumption, I suppose. But companies, like Tencent, Alibaba, and those kind of companies are likely to benefit, and that obviously has implications for South Africa with Naspers and Prosus and the likes. As an additional point, when it comes to China, is that their tech shares have not actually benefited from this recent rally in sort of tech in general. What this chart on the left shows you, I'll delve deeper in the next slide actually, is that the US-based kind of tech names have outperformed quite strongly, whereas the Chinese ones, which are kind of sitting below or in and around the zero line, have actually lagged. But the problem, I think, there with regards to China is that China is in a kind of a macroeconomic point right now where they're dealing with a few issues, and we've got kind of these 3 Ds that we've got here, which is the debt, deflation and demographics. We all know about the debt issues in the Chinese property and kind of development market. Deflation in that region in kind of Eastern Asia is also an issue, and slowing demographics have also hindered progress within China. Just zooming in on the chart on the previous slide, like I said, US-based tech names have outperformed, and this has really been, this year has been the year of AI, and a lot of these companies have really benefited from AI, and we believe that, the Chinese companies, similar to what the US have, they've got big databases, they've got good skills, they've got all the markings to also benefit from this AI bubble, but they've been hindered back by sort of a number of Chinese-specific issues, and we believe at some point this is going to turn. So we're turning sort of incrementally negative on developed markets, by extension the US, and turning incrementally positive on EM markets, and that should likely benefit South Africa as well. I won't go through this slide in great detail, but I think the point to be made here is that China has been challenged by a few macroeconomic issues, and I think this new strategy now of going towards a more consumption-led economy, again, is going to benefit certain companies. Certain companies are going to lose, like we believe the resources are going to lose. They've been big beneficiaries of the construction phase of China. We think now they're going to be losers, and companies based in consumption are going to be the winners in this kind of new phase of Chinese growth. It's going to be lower growth, but certain segments of the economy are going to be high growth, while others are going to be, again, losers in this new dynamic. And then focusing specifically on South Africa. So a lot of the issues are obviously living here, we all know about. We've got a situation where in this kind of dashboard that we've got here, there's been a lot of headwinds in South Africa up until this point, the load shedding, low growth, unemployment, everything that you probably seen in the papers. And we believe that a number of these factors are starting or have started to turn incrementally positive. So if I just touch on a few points, load shedding being one, obviously this year has been the worst load shedding year on record, but now we've come to a point where a number of private individuals, institutions have invested in alternative energy. So we believe that by the sort of first quarter of next year, there's going to be a big sort of kind of almost switching on of a big component of all this kind of alternative energy that we've imported. So that should alleviate a lot of the load shedding. We believe that obviously we are at the end of the rate hiking cycle. So by, again, first quarter of next year, we're going to see the first rate cut. We won't see one this year, I don't think. And then I think also, there's a bit of a base effect that's been set by this year. Everybody's been spending, for example, on generators and alternative energy, and these are all once-off costs that are going to then be in the base for this year, and we believe that earnings for next year are going to be look much better compared to the base for this year. We've been very troubled this year, and even though next year won't be necessarily like a very strong year, but it'll be a very good year compared to what we've experienced this year. So there's a lot of, we believe, a few tailwinds and a few headwinds that are turning for South Africa, which is why we're turning positive. Again, in keeping with kind of the benefits for EM, we think that Africa is going to be a winner in an increasingly multipolar world. Africa is 28% of the UN. It's 18% of global population, but only 3% of GDP, of global GDP. And we think that, as you can see from the various kind of packages and programs that have been announced, that Africa is likely to benefit from a new wave of investment that's coming in. I see that I've been warned here to wrap up, so I'm going to move relatively quickly. This is the, again, like I said, the theme of our presentation is really about what we have done to kind of reposition our portfolio towards SA Inc. now, as we believe that the local economy is going to start to experience a less tough time than what it has experienced this year. So we've moved quite a bit of our portfolio into the retailers, into property counters, and into other SA Inc. type of related shares. So, but I won't go through all of this in great detail. This is our positioning. A few names here to talk to. I mean, I think I'll just touch on a few. Multi-choice, the headwinds they faced in Nigeria, headwinds they faced locally with the declining subscriber numbers. We believe that a lot of that has been priced in. We believe that Africa is not being given a fair valuation in the mix, so we think there's a good opportunity in multi-choice. Like I mentioned, we've tilted into retailers, so we've got SPAR. We've tilted into SA Inc., so we've got ABSA, and a few other sort of SA Inc. type of names on the chart. But I'm happy to cover any of those in the questions section. Some of the underweights. We're underweight, the likes of Goldfields. We're underweight Sibanye because we're also cautious on on resources. We're underweight MTN for the issues that they are facing. I mean, similar issues to multi-choice, but we believe the difference with MTN is that they've got a big capex cycle coming. So we think they're going to spend a lot of expenditure on capex and the like. So we've turned a bit negative. But again, I'm happy to talk to any of these in the questions. Corporate activity has been a theme. In our local market, and you can see a number of themes that have, a number of shares that have come through. With on the left side of the chart, you've got a few of the corporate activity situations that have already happened, and then we highlight here with either low, medium, or high probability some of the corporate activities that we think are going to happen, and then we've circled some of the ones that we've got in our portfolio because we either believe that there's a good chance it's going to happen, or for other reasons like good valuation or good growth prospects. But I think corporate activity is going to remain a theme in our local market, given how cheap the local market is. Yeah. In conclusion, like I said, emerging market inflows are going to benefit. The ZAR could strengthen from here because we've had a very weak year. The macro outlook is turning incrementally positive. SA is cheap, as everybody is probably aware. Some corporate actions are still likely to come through, and we think that retail, property, and other SA names are a good place to be at the present moment. Thank you very much.
Thanks, Sonny. Hi, Ofri. Thanks.
Hi, good morning, everyone, and thank you for the opportunity to present today. My name is Ofri. I'm from Visio Capital. Visio was founded back in 2003. We are a team of 14 investment professionals, manage 36 billion of AUM, and that's spread across hedge funds, balance funds, sovereign, fixed income, and hedge funds. Our roots really are in hedge funds, and that's influenced our thinking and our process. We have an absolute return mentality. We very much fundamental research. We have quite a diverse set of skills in our team. From CAs to CFAs, engineers, economists, and mathematicians. We also have a good mix between grey hairs and some energetic youngsters. This is Visio Actinio. This is our longest running long only. It's very much a concentrated portfolio of our best ideas. Go into a little bit of an overview of the South African equities markets. Obviously, it's gone through quite a bit of headwinds. One of the headwinds has been the Reg 28 changes, and that's the limits for the offshore exposure. That's gone up from 35 to 45. In those charts, it shows for the balance funds what we've seen since it was announced in the beginning of 22. And there you can see that the offshore component going from 23 to 31%, and that has been funded out of the South African portion the South African equities portion of the funds. So you've had some of this selling in order to switch into the foreign equities. When overlaid on top of this, you've seen this, the foreigners continue to sell down South African equities. Their holdings have been coming down. And a lot of our stocks have actually been moved out of the international indices. So that was also another layer of yeah. So we have a shrinking South African economy, well, a shrinking industry rather, let's say industry, and less interest from offshore. And that's kind of meant that South Africa is kind of bumbling along the bottom of our valuations, you know, on the bottom end of the valuations. When you contrast that to what's been happening with the S&P and the recent re-rating that we've seen, and that's been this Magnificent Seven, this is historically a very, very wide gap. Now, historically also, we've actually seen that this thing eventually reverts again. So in the meantime, in South Africa, you can actually pick up some really, really good shares at really good prices. If we look at the fund positioning, we've kind of split this up into some very rough themes. We've got the offshore and the global companies like Process. It's a cheap entry into Tencent. It's also unwinding the very unpopular cross-shareholding that they've had, which we think will make it a lot easier for others to look at it. Richemont, this is the leading branded jewelry player in the world. Demand has been very resilient until yesterday when they came out of their AGM. BHP, what we like here is they are pretty much the lowest cost producers in all the minerals that they play in. And even if you consider, you know, the environment that we're in, that demand has been really lagging, and, you know, China going through all of its issues, it's still ranks very cheaply. I mean, it's you know, even if we take down iron ore prices and some of the other commodity prices, we bring those down, and you can actually it's still trading on like a 10 times PE, 5 to 6% dividend yield, and that's pretty attractive. Raynet, I've got another slide on that later. Momentum, either way that you slice and dice this thing has got a lot of upside. I mean, if you look at it on an EV basis, there's about a 50% upside. If you look at it on a cash basis and you build up your sum of the parts on the cash that's generated by the different operations, there's about a 30% upside. Sappi, historically Sappi was a very cyclical business and with high gearing, and that is a recipe for disaster. But the management team has been focusing a lot on bringing down the debt, and they've done that to some extent. And then their core markets, which was in graphics paper, which was in structural decline, they've been converting a lot of those mills into specialty products. So the cyclicality will start reducing. EOH, I suppose a couple of years ago, if you look at those inclusion criteria, you would have struggled to find a tick next to any of those. We only got involved in it post the recent rights issue after the management recapitalized the business. And when you look at the business today and you look at the trends that you're kind of seeing going forward, we like where they are positioned. There is the cloud migrations, the cybersecurity, there's the outsourcing of IT, and EOH is well positioned for those. The domestic champions, we've got the likes of Motus. Motus is not just a new vehicle a play. I mean, they've also got used, they've got rentals, leasing, spares, parts. So it's quite a diverse group. It's trading on a 5 times PE and a 7% yield. Famous brands. We really like the business model for the likes of the famous brands, because It's very capital light, generates good cash, and it has very, very high returns. There's even growth in famous brands, even in this kind of environment, because a lot of the independents are struggling and these guys are gaining share. Mr. Price, I don't think we've ever seen Mr. Price trading on such low valuations in its history. So we don't think the business is broken. We think things will normalize. People will realize that it's still a very good business. Advotech's involved in schooling and tertiary, and unfortunately in South Africa there's a real need for that. We've seen in the recent results that even though consumers are under pressure, they are prioritizing education. And once you get a student into grade 1, as long as you don't stuff up, you'll have that student for 12 years. On the property side, we've got Fairvest. There is a bit of portfolio optimization happening inside Fairvest after the recent merger with Arrowhead, but it's in the meantime, it's a 13% yield with growing at about 5%. Fortress, quite an interesting one. It's not a REIT anymore. It's got a very dysfunctional capital structure with the dual shares, which means they cannot pay dividends. But in this environment, it's actually been kind of a blessing in disguise, because as others have come into, the highly geared companies have come into some issues, these guys have been able to pick up some great assets and new developments that nobody else has been able to get involved in. So we don't look at it necessarily as a yield play like you usually would out of properties, but it's a compounding NAV play. Afrimat, a little bit more detail. Afrimat we've pretty much held since it listed back in 2006. It listed at the market cap of about 650 million rand. Today that's over 9 billion. They started off life as supplying aggregates to the building, to the construction materials businesses. And they've pretty much grown by doing very clever acquisitions. These acquisitions were always small enough that they never put the balance sheet on the company at risk, but the earnings out of those projects have been material enough to really move the needle in terms of earnings. The payback periods were typically between 1 and 4 years. And here on the charts on the right, you can see there's Demaneng and Jenkins. This is like 2 of the more recent projects. For example, in Demaneng, they've spent 320 million rand acquiring it. They've spent another 360 in capex fixing the business up. They made that money back within 2 years, cumulatively in profit after tax. Since the project started in 2018, they've generated cumulatively profits of 1.6 billion. Jenkins is another one. It's only in 2022 it started, and today it's already paid back the capital costs. There's another 2 projects that are currently in ramp up, and Afrimat's ungeared at this stage. So it's done all of these projects, done all these acquisitions, spent all of this capex, and it's still in an ungeared position. This is, we believe, one of the best capital allocators in South Africa. The last company is about Reinet. Reinet historically was a proxy for British American Tobacco, because it made up about 80% of the NAV. That's reduced to nearly 20%, and the bulk of the NAV is now in a company called Pension Investment Corp. And this is the business that we really like, although we like BTI as well. Pensions Corp is in the defined benefit space in the UK. It's not the most exciting kind of market, because it's ex-growth. There's no new members. It's probably going to get into runoff pretty soon. But there's a trillion of defined benefit schemes out there across 5,000 companies. And so far, only 300 billion of assets have actually moved into these specialist funds. £1 trillion is, roughly half of the UK GDP, and they've been moving across into the funds at a rate of about £30 billion a year. So even if you assume that only a portion of the £1 trillion will actually move in time, there is a very long runway. In the UK, currently there's only 8 players in the space. And because of the regulatory requirements, the barriers to entry are very high. On our forecasts, the net asset value of Pensions Corp will double over the next 3 to 4 years as they take on a lot of these schemes. And when they take on these schemes, you have a predictable liability for the next 20, 30, 40 years, and you're getting the assets and you invest those to match the liabilities, and out of that comes a decent margin. So you've got predictable cash flows for a really, really long time. And I think this is a very attractive place to be. And that's me. Thank you.
Thanks, Barry.
Okay, good morning, everybody. Thank you, BCI team. Thank you, Tanya, Robert, Eugene. Thanks for having us here today to address this great audience. It's good to be back. My name is Barry Shamley. I work at Investec Investment Management. I like to call us the new old kids on the block. We've been around for a long time working within wealth and investment, but since 91 left, we've been given the flexibility to start dealing with not just Investec clients, but all clients. What is Investec Investment Management? What is our purpose? We're a specialist international investment manager with a client-centric approach to active asset management. Trying hard, I almost got this yesterday. As trusted stewards of generational wealth, our long-standing global investment process delivers distinctive investment solutions, and as a signatory of the PRI, we demonstrate our commitment to responsible investment and sustainability. What I didn't leave the slide on long enough for is we've got over 220 billion in assets. We've got probably about over 50 investment professionals. This slide here is just our investment analyst team, headed up by Chris Holdsworth. He heads up from a top-down perspective. He works with Awesome as well. From a bottom-up perspective, we've got Clive Stodersdake, Campbell Parry, Jimmy Machachateri, Eddie Hargreaves, Kevin Harding, Nontazulu, Peter Vogel, Thane Duff, Zain Corsi, Jomfana, and Zain Bezaidnote. I'm sure a lot of you will be familiar with some of them. A lot of them come from the sell side. They were top-rated analysts in their day, either on the Investec sell side or at other institutions. Cumulatively, I think it's over 130 years of experience just at Investec. Some have got a little bit more. So a summary of our view at the moment, I think everyone's got a pretty similar view. We feel like inflation has more or less gotten under control globally, but there does seem to be a slowdown in global growth that is imminent. We feel US earnings forecasts are a little bit optimistic. We also note that we're at peak multiples and at peak margins in the US, which is a recipe, I wouldn't say for disaster, but I mean maybe just not going anywhere for a while. We're seeing greater value outside of the US at the moment. So you'll see in some of our global processes, we have started moving a little bit out of US into some of the other developed markets. But nevertheless, because of this growth slowdown, we do think the US dollar is going to remain stronger in the short term. So our longer term view is for the dollar to weaken a bit, but in the short term, with a slowdown in growth, we do think the dollar could be strong. Chinese growth has been disappointing. We all expected a nice bounce back after the COVID reopening. Unfortunately, the property development sector has created a massive overhang on the economy. So far, the stimulus has been disappointing. I think there may still be more to come. I think there's still more they can do, but I think they're also quite cautious of blowing new bubbles, and they are also cautious of it creating too much debt. But there is certainly scope for more stimulus. Just recently, they reduced stamp duty again on share transactions, and they're putting in some measures to help reduce mortgage rates. So I think there is more they can do, but I always often sort of say to myself, though, we kind of couldn't figure out why the Chinese market was doing so badly for the last 6 months. All of this news is coming out now. So you've got to remember, equity markets are forward-looking. A lot of this bad news is known now. It's not time now is not to panic. A lot of this is already in the price. On a positive note, we do think that the global energy transition in the long term will still be very supportive for commodity prices. So SA risks and opportunities. We think we probably passed peak load shedding, so it's created a very high base. We think, as some of my other presenters have noted, that over the next 2 years, things will incrementally get better and provide a good starting. We've got a relatively good starting base for things to improve. Inflation is well within the band, and we expect it to stay there for the foreseeable future. We actually expect the SARB to cut rates by year end. That's our house view at the moment. And we think the net result will be positive for SA Inc. We have started seeing some emerging markets cutting rates already. We've seen Brazil and Chile do so. I think developed markets will follow early next year as well. On the downside, the SA government is under fiscal pressure given the pullback in global commodity prices. And also there's been little improvement in Transnet. SOEs are still a big pain for the economy. On the positive note, though, I do think as we allow Transnet to partially privatize, I think we will see that even if commodities do stay at these low levels, we will start exporting more commodities. So there will be some potential uplift to the mining companies next year. As a country, we are well positioned for renewables, just in terms of our natural assets, the wind, the sun, and the commodities we have in the ground here. I think something worth reiterating, and I was reminded of it, we had a presentation by Gigi Alcock last week again. The informal economy is unmeasured, and the actual growth and employment is probably massively understated. So there's a lot of growth in the economy that's not being measured, and some of the growth rates you're seeing in that economy are actually way above the formal economy. So I think sometimes things are a lot better than what we seem. I know South Africans we generally glass half empty, but there are some silver linings out there. And then I think somebody else also mentioned the potential for impact funding to come into our country and help deliver on some of these infrastructure goals. There's a lot of concessional finance from development banks globally looking for a home here at attractive rates. And I think what we've also seen over the past decade, because of very low rates, people have been very keen to invest in long-dated growth. So you were happy to give up cash flows in the short term because you knew there was this promise of returns in the long term. Now with rates high, you don't have that luxury of giving up or sort of cheap or free money. So people are looking for more predictable cash flows. I think particularly in the developed world as well, there's been very little infrastructure redevelopment. I think there are a lot of run-down highways, bridges in the US globally that I think will be supportive of commodity prices in the medium and longer term, which will be good for emerging markets and particularly for commodity exporters. Just taking a look at the year behind us what I've done here is I've done a split of our sort of long-term growth portfolio, which is a segregated portfolio, and our dynamic equity portfolio. What's worked in the last year has been Naspers, the Goldfields, Richemont, Billiton. On the downside, we've had a couple of our retailers, the platinum stocks and Anglo's Mr. Price. So it's been a tough year if you haven't held a Richemont or a Goldfields or a Naspers. But now you've got to take the view and say, well, all of these retail companies are coming out with poor numbers now, and we're near that peak in interest rate cycles. How should we be positioning our portfolios going forward? So we like to break the market up into buckets. We've got global consumer plays, commodity price plays, precious metal plays, and interest rate plays, and one or two other little boxes. As you can see right now, we're slightly overweight on the commodity price plays. That's because that includes the likes of a Montauk and a Mondi in there as well. We're quite overweight on the global consumer price plays, which has worked for us over the last year. We're kind of equal weights on the interest rate plays. But as a house, we are now actively looking for more cyclical SA Inc. plays to start moving into as we see that sort of peak pessimism and that trough earnings in the SA interest rate plays. I'm not going to go into this slide because it's a bit too busy. This is the highlight of the previous slide. So these are our top ideas per factor. We've spoken about Richemont. We think luxury, hard luxury is a structural growth sector. What we like about Richemont is it's very conservatively positioned. It's got 6 billion euros on the balance sheet. Unfortunately, that holds back their margins a little bit. On a cash flow and return on invested capital basis, if you strip out that cash, the return jumps from like 9 to 16%. So we may question the wisdom of holding this cash on the balance sheet, but nevertheless, it's nice to have it in tough times, and it's working for the Rupert family. We expect about 6.5% sales growth. They've been doing the right things in terms of having their own stores to market and sell their watch brands. And interestingly, if you actually exclude Jufrey and Farfetch and you just look at that core luxury business, it's only trading on a 13.5 times multiple. So as Ofri noted, yes, they did have a bit of a warning about sales at the moment, but the share price has actually corrected. So like I said, markets are forward-looking. We've already seen the market anticipating some of this and has already come down. Maybe it'll get a little bit lower in the short term, but this is a really quality long-term growth play. What I didn't mention in the beginning, just as a house, we're very much quality and growth focused in our core equity portfolios. It's just the dynamic equity portfolio fund, Investec BCI Dynamic Equity Fund, that is a little bit more opportunistic and goes into some of the more value opportunities sometimes. And Anheuser-Busch, it's a bit of a self-help story. We believe with new management, organic growth, they will probably grow at about 5.5%. We think they will deleverage to 3 times net debt to EBITDA, which will then help them screen better on global balance sheet screens. We also think it will open up the option for them to do buybacks like Carlsberg and Heineken have been doing. Also, these beverage companies are trading at massive discounts to the other consumer staple stocks. So a nice solid quality rand hedge play. On the more interesting ones, Pan-African Resources, what we like about it, generally over their history, they've been pretty good at guiding their production and meeting. They did miss recently. It's fallen off a bit. They've changed their production guidance. This is a high-quality company. It's one of the highest return on invested capital gold miners on the JSE, probably double a Goldfields or an Anglo's, but trading at half the price, and just because it's a smaller company and not that accessible to larger asset management houses. Northam has been disappointing. I mean, we have it because we do think that a lot of the pain we've seen in the PGM space is not just because of the forecast demise of internal combustion engines, but also because we believe Russia has been selling a lot of PGMs out the back door and depressing the PGM price. We hope that will normalize in time. Northam is the only one with real volume growth. They're quite nicely down on the cost curve, and they've just started paying some dividends again after exiting that RBP position. Standard Bank we see as JP Morgan or HSBC of Africa. That large regulatory capital base gives them access to many more lending opportunities than anyone else. We think they are on a forward of a 1.2 times price to book, which is about a 14% discount to their 5-year average pre-COVID. It's just a solid and steady access point to the banking space. Also, I'm running out a little bit of time, so I'm going to rush a little bit. But Truworths, just have a look at their return on invested capital, more than double the other retailers. They haven't run out and tried to buy earnings like the other retailers have done, and yet they stay trading on the same PE multiple. Not to say we don't want to buy the others. I think the opportunity with the Fushinis and Mr. Price now is as the headwinds turn to tailwinds and that revenue growth picks up, I think they will probably do better. But Truworths has navigated this tough environment a lot better than what I believe Fushinis and Mr. Price have. Spur, great company, 10 multiple. A restaurant is becoming like the preferred out-of-home entertainment. They've got a barbell approach to it from the low end to the up end. Hussar Grill on about a 7% dividend yield, and their cash flow return on invested capital also amazing. Like I said yesterday, you probably would pay double the price for this company if it was a large cap company. It really is just a great company, and also one we're happy to be able to access because we are small and more nimble. Adcock, again, probably double the return on capital of Aspen, more predictable, same valuation. Stadio, one of the best SA growth stories, with UNISA potentially going into administration. This just opens up a whole area, easy pickings basically for Stadio. 40,000 students at the moment. They always said that their target market was the UNISA target base, and that opens up potentially 400,000 students for them to grow. Not cheap on about a 20 multiple, but we can see a long growth runway. The last one I'm going to mention, Nampak. They've just gone ex-rights. They're raising R1 billion. We've been intimately involved with A2 Investment Partners in changing the board there, helping bring down the size of the rights issue. We believe they can be debt-free between 3 and 5 years. There's a lot of optionality. A lot of things are not being valued in there, like what they've got locked in Zim. We find exiting it on a 5 times EV/EBITDA multiple, and with fairly conservative estimates on revenue growth and EBITDA margins, we get to almost 3 times your money. So I'm not saying you're going to make that. We don't have a big position size in that, but that is something exciting that we have a small position in. Interestingly enough, Coro have underwritten 300 million of this rights issue now, and they don't have a stake yet. So they obviously see something there like we do. And that is it. So just to wrap up, we think the time to buy SA Inc. is when interest rates have peaked. We think we're there. And as a result, we are slowly transitioning our portfolio away from those global consumer plays and more into that SA Inc. space. Thank you very much.
Thank you, Barry. Any questions for our panel from the audience? Right, no one. Very quick question from my side to all 4 panelists, and it's all about ESG screening. Does it make sense in a SA equity environment where we've already got a limited or less shares or options to choose from? Ofri, if I can maybe start with you. I know from a corporate governance point of view, Visio has always been very, very focused and very strong on that. How important is ESG screening when you look at selecting securities in your portfolios?
So governance is obviously probably the most important of those. But if you look at what happened with the SASO and BTI a couple of years ago, when ESG was quite a big hype, and a lot of people were just like, we can't touch this. It cost them because you don't have alternatives. You cannot switch from a SASO to somebody who's a bit more, I don't know.
Yeah, what do you do?
Like there's no alternative, and also to BTI. So I think the governance is important because it has very, very short-term kind of impacts. We are aware of the long-term impacts also for the likes of a SASO, and you can kind of see that in the carbon pricing and the taxes and stuff. So yeah, that will come down the line. So it's still there, but you cannot, it's almost like you cannot blacklist anything. There's a price for everything right now in a small market.
Makes a lot of sense. Tumi, where maybe want to go next from a 361 point of view?
So agree with Ofri in terms of not blacklisting. So we don't do any negative exclusions on the SA equity front because sometimes something is priced, even if it's an ESG concern, it's priced at a level where we're willing to go in. I think what's important for us on the ESG front, so we do screening in terms of analyzing where's our portfolio ESG risks, the majority of the ESG risks, and being aware of where we are on that ESG spectrum. Are we, there are unintended consequences of ESG. So people were concerned about energy, and then suddenly when it's a cold winter, they're willing to now invest in coal, for instance. So being aware of where your portfolio ESG risks lie and being aware of where we are in terms of that ESG spectrum. Are people more concerned about A versus B, and considering that in your ESG issues when you look at your portfolio?
Yeah. Sunny, you want to comment on that?
Yeah, I don't think there's anything else I can add from the two views that have already been shared. But I think the main point to make is that you need to separate between sort of the kind of the moral argument around what's right or wrong with regards to all these ESG things, and the investment case of any company. You know, another example would be like something like a Tumi that came out of Anglo-American. You know, that share went down to 20 rand because people were dumping it like hell when it came out.
Yeah.
But, you know, obviously no one knew the extent to which you know, there would be an energy crisis in Europe that would then, you know, propagate the need for higher coal demand. But even outside of that, you know, there's a kind of base level demand for fossil fuel based energy, you know, and you can't just kind of throw the baby out with the bathwater when it comes to these things. There's a balance to be struck, and our view is that we try to value, you know, the ESG issues that we identify for each company and try to see if they are actually being discounted into the price.
Thanks, Brad. Very sensible. Barry, anything you want to add from an investing point of view?
Yeah, so I think it's important to understand the risks so that you can price the asset appropriately. I think for a long time people didn't think about, for instance, the carbon tax, how that could potentially be increasing over time and how that could reduce your cash flows. But I think more importantly for us, it's about actually finding companies where there are problems, engaging with them and helping them change those problems. So for example, we're a member of Climate Action 100+, so we engage with a group of asset managers with Sasol, and we are helping them transition. So through owning these assets and improving these companies and helping them reduce their ESG risk scores, there is an element of alpha that can be achieved. So we think it's not just for, like you said, for exclusion, but actually you can achieve alpha through doing it properly.
Yeah. It needs to be a sensible approach. Ladies and gentlemen, thank you so much for being here today. If you can stay for tea, then the audience can have a couple of discussions with you. We're not breaking for tea just yet. Next up, we've got our fixed income guys, but thank you all for joining us here today. Really great. Thank you. Right, fixed income, always much talked about. If you look at end of August 2022, for a 12-month period, fixed income funds averaged out more or less about 5% over a 12-month period. Fast forward, end of August 2023, fixed income funds did more or less double that, despite a period with extreme interest rate hikes. Can you imagine what fixed income can do for you or for your clients if you think that we may be at the top of a rate hiking cycle? Right, so we've got a great panel for you again this morning on fixed income. First up is Monica from Aluwani Capital. Monica, thank you so much for being here today. I'm not going to call them all to the front now, but after Monica, we have Nolan Wapenaar from Anchor Capital, who will be followed by Philip from PMX, and then Arno from Sasfin Asset Management. Monica, thank you so much.
Thank you, Eugene. Thank you, Tanya, and thank you, BCI, for hosting us today. Good morning, ladies and gentlemen. My name is Monica Jaglal, and I am one of the portfolio managers on the Aluwani BCI High Yield Fund. Some misconceptions fizzle out, while other misconceptions can perpetuate for generations, like the one most of us would be familiar with. Swallowed gum takes 7 years to digest. Not going to exactly cover those misconceptions today, but a specific set of misconceptions when contemplating credit investing for income. Oopsie. Just kicking off with the Aluwani BCI High Yield Fund. Our head of fixed income, Conrad Wood, and myself are the portfolio managers. The fund sits in the SA interest-bearing short-term category. The benchmark is STEFI plus 3%, and the fund is currently at 1.5 billion, with its inception being May last year. This fund is different from your typical income fund. It takes credit risk, liquidity risk, and term risk by lending to a wide variety of borrowers across all sectors of the economy in a risk-adjusted fashion. So over the fullness of time, the yield compounds and aims to exceed any impairments to get to STEFI plus 3% on a sustainable basis. It should be noted that this fund has no exposure to your traditional fixed income asset classes, the likes of ILBs, listed property, or nominal bonds. The fund is predominantly exposed to floating rate instruments. Just looking at the actual performance of the fund, If you cast your eye to the graph on the bottom right-hand side of the screen, you'll see the fund's performance in the orange line since inception has beat both STEFI and CPI considerably. So today we thought we'd unpack 3 misconceptions that we frequently encounter when engaging with our clients. The first one being, credit is expensive. Next one, the lack of credit issuance and diversity in the South African listed market. And the last one being, high yield equals high risk. So over the past 12 to 18 months, we have repeatedly heard how expensive credit is. And often this assertion comes from looking at where credit spreads currently are relative to where they have been historically. But you would not look at equities or bonds on this basis. For example, you would not look at the Sasol share price that's currently around 250 Rand and say it's a screaming buy just because it has been as high as 600 Rands historically. So why do that for credit spreads? This is most probably because of the lack of good data when it comes to return and risk. But still, it doesn't mean that you should have no valuation approach when looking at credit spreads. You need to consider both the expected return and risk when evaluating what an appropriate credit spread should be. So putting on a risk-adjusted lens, if you cast your eye to the top left-hand side of the screen, you will see a chart there with credit spreads. The blue line being your 5-year government spread, blue dots, your 5-year bank spread, and the yellow dots, your 5-year corporate spreads. So historically, government spreads have traded at 50 basis points, whilst your corporates and your banks at 150 basis points. So you are earning 100 basis points premium relative to government for both banks and high-quality corporates. However, over the last several years, the government risk has deteriorated markedly. However, the same cannot be said for your banks and your high-quality corporates. If anything, we can argue that the risk of banks have actually improved on the back of tighter regulation that requires banks to hold higher capital levels as well as higher provisions for bad debts. So we don't think that the same yield or a premium pickup relative to government is still warranted. Another factor that needs to be considered is that the absolute level of interest rate is much higher compared to historically. If you just cast your eye, keeping on this risk-adjusted lens, to the right-hand side of the screen, what we've done here is taken your 5-year generic probability of default and loss given default for each rating band. So for example, on your AAA rating band, you've got a probability of default of 0.2% and a loss given default of 20%. And then what we've done, if it's gone and taken our allocation to each of these rating bands and worked out what the expected loss for our portfolio would be. And this comes out to 1.3%. So remember, I said you need to consider both expected loss and expected return. So we've got expected loss for the portfolio at 1.3% on a cumulative 5-year basis. And then if you look at the expected return for the portfolio being STEFI plus 3%, but STEFI plus 15% on a 5-year cumulative basis, we think that investors have been more than compensated for risk. And we could even suggest that perhaps credit spreads have historically been too wide. Moving on to the second misconception, the lack of issuance and diversity in the South African market. If you look at the graph on the left-hand side, you'll see the evolution of issuance in the South African listed space. So this has increased quite considerably since the early 2000s and has peaked in 2019 at around 170 billion. This year, it is forecast to be 130 billion. So nowhere near the highs of the pre-COVID levels, but that's expected given the lackluster macro environment. But as we've all just heard from our equity panel just now, that the macro is starting to turn, and we're expecting a much stronger 2024, and in turn, issuance to pick up in 2024. It should be also noted that we've had a nice mix of sectors come into market in that issuance profile as well. A good mix between your SOEs, your banks, your corporates, and securitizations. On the right-hand side is the trading volumes in the secondary market. This has hovered around 10 to 15 billion on a monthly basis. And interestingly enough, it has peaked during COVID at around 25 billion. So we don't think that the lack of issuance is a problem in the South African market. Rather, it is the excess demand that's resulting in a bun fight in the listed market. However, the way that we've set up the fund is to play in the private credit space, where there's more diverse opportunities and it is less competitive as there's fewer players in the space. Our investable universe also doesn't stop at your investment grade. Other building blocks in the fund include your sub-investment grade, offshore, credit-linked notes, securitizations, as well as credit indices. So we would allocate to each of these building blocks depending on where we are in the credit cycle. It should be noted that the fund has exposure to 9 different sectors of the economy and 67 different borrowers, speaking to how broad our investable universe is. The last misconception, high yield equals high risk. Of course there's risk. You cannot get to Steffi plus 3% without taking any risk. But how you manage this risk and how much credit spread you get compensated to take this risk is vital. Risk is mitigated in our fund via various methods. The first one being robust credit analysis to avoid the wobblies to begin with. We have careful counterparty selection, so we are not lending to each and every borrower that's knocking on our doors for money. The next mitigant being diversification, because, like I said, there will be credit impairments, wobblies will happen. But if a counterpart is capped at 2% of your portfolio and it goes belly up, it does not blow the fund out the water. The last mitigant being covenants, collateral, and credit enhancement, which improves recovery rates if they are wobblies. In conclusion, this portfolio gives you something different as opposed to the increasing vagaries of the traditional fixed income asset classes. I think Eugene opened up this morning about forecasting and how nobody has gotten it right over the 12 to 18 months. There are attractive and diverse opportunities across our investable universe. Risk is managed and compensated for. Our portfolio is also well positioned for market transition into the private, bespoke, and more specialized investments. Thank you very much. And don't forget, it's fine to swallow your gum.
Thanks, Monica. Nolan? Yes? No, it's fine.
Hello. Okay, I'm live. Thanks, Monica. So it's wonderful to be back here. I actually really enjoy the Pretoria stop on the sort of presentation circuit and a lot of familiar faces. So thank you. I'm here from Anchor Capital. I'm going to talk our perspectives on fixed income for the next 13 minutes and 53 seconds. I've got a timer up here timing me. But before I do that, just a broad sort of the way that Eugene has put this together, I'm going to largely stand up here and agree with Monica. I actually do think that it makes a lot of sense to invest in credit right now. We're going to explain why. And then you're going to get two guys who come up after me and tell you that I'm nuts. So with that in mind, how do we look at the world? And Eugene started earlier talking about different perspectives on where we've come through, and projections have been a bit off over the last while. I'm going to delve into that a bit. From our perspective, we're talking about flexible income funds. Flexible income funds are multi-asset portfolios. We build the portfolio up of different categories of bonds, maybe put some property in there, maybe put a little bit of equity, but it's a multi-asset portfolio. So we don't just want to lean on one particular asset class or one category of fixed income. What we do is we look at where the best opportunities are and we sort of lean into those opportunities. So cast your mind back. What did we know? And it's almost 2 years ago to the day that inflation was actually transitory. I'm sure we all remember that one. And it was September 2021 when suddenly the world woke up and said, wait a minute, inflation isn't transitory. US inflation is going to 9-something%. South Africa's in trouble. And we had this sort of interest rate rising environment took off. And what I've got here is a chart of the yield on the US 2-year bonds. And the point is that, obviously forecasters got it wrong. Yields globally have been rising. They continue to rise today. I know everyone's talking about peak rates and interest rate cuts and that. The honest truth is the US 10-year yield today is higher than it was last month this time. And we continue to be in this rising rate environment. The next thing we all talked about was China reopening from COVID. And you had to position for the sort of resurgence of economic activity in China. Everyone went and bought Alibaba and a lot of other things, and that resurgence didn't really occur. And, that's again another example where we potentially got, the forecasts a bit wrong. But what really happened in China is that the property bubble is coming under pressure. And we've seen that with defaults like Evergrande, Country Garden, etc. And the business model of those property companies was that they would take full payment for your apartment up front. So you'd go to Evergrande, you'd say, right, I want to buy an apartment for my savings. You'd pay them whatever it was, your 2 million renminbi, and they give you a piece of paper saying they're going to build this apartment. To pay that, you obviously get a mortgage from the bank. Problem is they never built those apartments. So now you've got this situation where the property company is in trouble, it's busy falling over, and your apartment's never been built. And you've got a 20-year mortgage from a bank who's trying to collect on this apartment. That creates a massive, massive pressure point. I'm not going to be happy paying for the next 20 years for a piece of property that was never built. And at the same time, if I default on that and I say, well, I'm just not paying this, then the bank has actually got nothing it can go and repossess. So you've got this massive, massive sort of crash in confidence in the property sector in China. Now, the property sector, depending on how you want to measure it, it's about 30% of the Chinese economy. That's weighing down China right now. It's weighing down their confidence. That's what we need to work through. Now, that's actually good news for South Africa, and I'll get to that in a few seconds. And then the final aspect I want to talk about is we all knew at the beginning of this year we were reaching peak rates. In fact, that was a big thesis back in January. And what I've got here is a chart, and you can kind of see the stepped line on the chart, the dark line, and that's really where the Fed funds rate was. So those are the actual interest rate hikes from the Fed funds. And then you've got this blue curved line, which is a little bit lower. And that is what the market was projecting in January for interest rate hikes. Market got it wrong. In fact, the market was saying by July the Fed would be cutting interest rates, and yet they hiked. And today we're sitting significantly above where the market was expecting. And the point is that it's very, very difficult to call peak rates. I think economists will tell you that the most difficult thing is to actually call an inflection point when things are going to change. It's always easier to back a trend. Come back to the slide in a second. But what does that all mean? Well, we've got this world where projections have been almost impossible. Nobody's got it right. The market narratives have been wrong. That means that your client portfolios have been incredibly volatile. I don't care whether you've owned risk assets in equities, in bonds, in the rand, whatever. It is just naturally, this is a volatile environment. And our clients are tired. I'm feeling it at Anchor. I know other people are experiencing the same. Clients are just tired of the volatility, particularly because a lot of this is volatility that really has gone nowhere. So from that perspective, I'm seeing a lot of pressure actually from clients at the moment to move towards credit funds, similar to what Monica was talking about. We run the Anchor BCI Core Income Fund, which is kind of an Anchor equivalent of Monica's fund. And we're definitely seeing a sort of tilting towards that right now, where people are just saying, give me that 9.5% return that Monica was talking about annualized. It's kind of what we're doing as well. But give it to me in a form that's got less volatility. I just can't take any more of this. And I think that environment is going to persist. And let's look then at today's narrative and explain why. So the chart on the left-hand side is the same chart we saw a second ago, the step function, the blue curve of where rates were. But right at the top, you can see a sort of red dotted line, and that's what the market is projecting for interest rates going forward in the USA. And the market is basically saying largely flat for the foreseeable future, potentially interest rate cuts. So that's the market narrative right now. We've reached peak rates. We think we're done with peak rates, start positioning for interest rate cuts. And I think I've heard that actually from other speakers today. I think you'll hear it again. We're close to peak rates. And I'd agree with that, but with a big caveat that we'll get to in a second. Looking on the right-hand side, we've basically drawn, using South African derivatives phrase, we've looked at what the market is pricing in for South Africa. And what you will see is that interest rates are flat, and then around about the end of this year, maybe December, maybe January, markets are pricing that a South African interest rate cutting cycle starts, and we cut interest rates from repo rate from where it's at now to about 7%. So maybe it's a percent and a half type interest rate cutting environment next year. That's what the market's talking about. We don't buy into that at Anchor either, and we think we need to be very skeptical of that. And the point is, let's just look at where the market could be wrong, having seen that the market's got it wrong so many times. So why might the market be wrong? Looking at the USA and the US peak rates, what we have here is a chart of US unemployment. And you can see how through the recession of 2004, the tech bubble effectively, US unemployment spiked upwards. You can see through the great financial crisis of 2008, unemployment, and then you can see COVID crisis. So for a good recession, you actually need significant unemployment. You look at the employment rates right now, actually they're towards all-time lows. This isn't a recessionary environment. Yes, unemployment ticked up a couple of basis points at the last measure, but that wasn't a case of jobs are disappearing. It was actually a case of excess jobs luring more people into the marketplace. So from that perspective, the jobs are available, people are actually still in a very strong position. It's difficult to actually talk about a massive recession in the US, and consequently, they've got a strong economy. So then why would they cut interest rates? Let's look at the US inflation rate. And this is the chart of inflation. You can see how it peaked. It was actually at a 9.1% peak for those of you who remember. And inflation has come down quite significantly, sort of touched 3%, 3.2% right now. Point is that when we go and look at the forecasters, the big forecasters globally of inflation, I'm not seeing one of them get inflation back to 2%. I'm seeing a sort of 2.5% to 3% over the next 12 months, maybe longer. So where are we really going to be? Well, we're going to be in a world where inflation is above the US's 2% target. We're going to be in a world where the US economy is strong. That makes for a very difficult argument for cutting interest rates. And our perspective actually, therefore, is that interest rate cuts are a lot more delayed than people expect. That we think earliest is second half of next year, possibly even longer. And that's just because it's not a natural interest rate cutting environment. So the Fed can afford to be patient. And the cost of being patient is very little while you're at full employment. So from that perspective, we think that yes, we may be nearing peak interest rates. We do see a little bit of risk for yields to actually push a touch higher. But the point is that this big bond boom, this big bond sort of frenzy bull market that people talk about, that's not in the next 12 months in our view. So we're going to be patient for that. Looking locally, it's all about tax collection. I think people have talked about tax collection coming down. You go and do the math, and it's all coming from commodity companies. The mines are basically making a lot less money. We've all seen that. Consequently, they pay a lot less tax. That's not great, and that's putting our fiscus in a tight spot. let's talk about the tight spot for a second, and then I'll come back to China. So from that perspective, we're all sitting here, and the government is basically in a really difficult spot because it's got a budget that's got to put out in October, and that budget is going to say we're going to cut spending. They might try and push taxes up a little bit as well, but there's only so much they can do. Fundamentally, that's a very difficult budget environment, particularly going into an election year. I mean, the ANC really doesn't want to come out and say, hey, we've got to cut social grants or social spending into an election. That's just suicide. So that's not going to happen. Very, very difficult budget. They're going to be walking a very fine line. The market is skeptical. What does that mean? As the market becomes skeptical, bond yields in South Africa are rising, and they rise on the far end. So that's the 2044s, the 2040s, 2053s. Those bonds are going to continue to come under pressure while the market digests a mini budget speech in October, and then at some point most likely goes, yeah, I'm not sure we believe that. So from that perspective, we hear this interest rate peak environment, but there are risks that could actually push interest rates higher, and we've got to be aware of those. So coming to China very quickly, and my time is ticking down very fast here, but China, remember I said the problem is they haven't built these houses. So stimulus in China at the moment is increasingly focused on going to these property companies, Evergrande Country Garden, saying to them, you need to build these properties. So it's all focused on saying, go import raw materials from Africa, build these properties that you've pre-sold, and deliver them to the people so we can sort this mess out. From our perspective, actually, the outlook there is probably a little bit better. So I think there's definitely some upside. But pulling it all together, what does that mean for Anchor in terms of portfolio construction? What should we look at? How should we look at Anchor? Our perspective and our message to you today is we're in a world where taking a lot of bond risk probably is not really going to pay you for the next year. Okay, there are a lot of risk factors that are going to keep bond yields higher. You're going to get volatility. You're not necessarily going to get massively improved returns. You don't need that risk. Clients are tired. Let's play defense right now. You can play defense. If we're right, actually you look like a superhero to your clients. And if we're wrong, you know what? It's going to be a very shallow interest rate cutting cycle. Your opportunity cost is going to be very, very low. So if we're wrong, it's going to be a small impact on your portfolio. And if we're right, it's fantastic. So from that perspective, we're playing defense right now. Our portfolio is tilted towards credit. We're leaning towards investment grade credit. There's plenty of liquidity, as Monica was saying, in that market. And we're underweighting bonds. Where we do take bond risk, we prefer firstly US bond risk. So when we are positioning for interest rate cuts, we're using US bonds, not South African bonds. Currency hedge back into rand. We do that so that we don't pick up all of the sort of South African budgetary woes in our portfolio. And where we do take South African bonds, we like bonds out of the sort of 10, 15-year area, which is kind of the pivot point where lower interest rate will kind of help the bond and it'll kind of counterbalance the challenges that the government is facing. So from that perspective, we're looking to be a lot more defensive right now. We're not going to have the wild swings up or down. And therefore, we think that that's actually quite compelling for our investors. We've definitely noticed investors moving in there probably over the last 3 or 4 months. But I see my timer is out, so I'm going to end here, and I'm going to hand over to Philip. Thank you. Oh.
Thanks, Nolan. And I'm not going to totally disagree with you because we all invested in the same sort of markets. But at the end of the day, we think that actually when investing for income right now, the odds are kind of stacked in the favor of SA bonds. So I'm going to be talking about investing for income. And I'm going to use betting odds and some analogies that I think will make it a bit real for you. My name is Philip Bradford. I'm the head of investments at PortfolioMetrix. I'm not going to talk too much about the company. I manage the dynamic income fund as well as the bond fund, and I get very involved in the overall asset allocation process as well. And really what we're trying to do in the dynamic income fund is to look across all of the interest rate opportunities that are available in South Africa at the moment and try and generate the best rand return possible. We're really almost shopping around for the best interest rates, and I'll unpack that in a second.
We're a global team. We manage just over 65 billion rands worth of assets. But importantly, our global team works very closely together. Our fixed income team, and we're involved in all aspects of asset allocation as well. We borrow a lot from the learnings we get from asset allocation when we manage assets within the fixed income space. And we can talk about performance and the likes, but we've won a number of awards as a team, particularly over the years across the different track records. Now, the combined mandate track record, we've run just over four Raging Bull Awards for this specific mandate and the way we've run it, as well as across our bond fund and our multi-asset funds as well. Importantly, this was 4 years ago. Can you believe it? 4 years. Does anyone notice the odd one out here? There it is, Ramaphoria. It was the back end of Ramaphoria. It was the end of Ramaphoria. Ramaphoria had actually started 1 year before we won the Rugby World Cup at the year before that, and markets have been going along fantastically. But if we look at bonds, and we use the team analogy here, bonds have been on a losing team. If we go back to the slide starts in 2010, and by the way, everything that looks up here is actually bad. So black line is the rand-dollar exchange rate, which starts at 7 rand to the dollar on the left, and the blue line is bond yield. So as bond yields go up, you'll notice there's quite a strong correlation between bonds and the rand. It's almost like the share price of South Africa. And what we've seen over this last period of time is the rand's gone from 7 to over 19. It was 19.30 yesterday, around 19.20 at the moment. And bond yields have gone from around between 9 and 10 all the way to over 12 at this time. We actually started running the mandate that we've been running way back in 2015, and our timing couldn't have been worse. We did it just before Nenegate. Nenegate was an absolute disaster. We saw the rand weaken. We saw bond yields weaken significantly. After Nenegate, we had the Ramaphoria times. Can you believe it? 5 and a bit years ago, the rand was at 11. Bond yields were around about 8 at the time. Things were looking quite good. After that, though, we had state capture starting, and then we had the last Rugby World Cup. I'm using this, I'll show you why in a moment. But I stood up here and I must apologize. 4 years ago, I said, bonds are really well priced. No one believed the Springboks were going to win. 4 and a bit years ago, believe it or not. We all thought the All Blacks were going to win, and I said it was like getting the All Blacks at 10-1 because they were going at almost even money into that Rugby World Cup. We know how that ended, of course, but we also know that bonds subsequently have done actually pretty badly because we had COVID, which was 3 times worse than the financial crisis in terms of the impact on our bond market and obviously the global economy. We had a bit of a recovery, and then last year, what did we have? Well, we had the start of the Ukraine invasion. We then had the inflation crisis globally, which was exacerbated by the Ukraine invasion. We had the Fed hiking far more aggressively than anyone could imagine. We then had Pala Pala later on in the year. We were almost expecting it because we know ANC elective conferences are normally good buying opportunities, we found, by the way. Energy crisis going into the start of this year as well as into May was the height of that. And then right at the end of that was the Lady R Russia ship parked in our harbour when everyone thought South Africa was going to get chucked out of AGOA. So you'd be forgiven for thinking we've actually done really badly over that time. But the irony is actually the bond market has done relatively well. It's actually done better than the equity market. It's done better than high equity balanced funds. It's done better than any other asset class. Our portfolio has actually done quite a bit better than that. We've beaten the bond market by nearly 2% per year over that period. But importantly, as well as ahead of the peers over the longer term period. So the crazy thing here is that bonds have been almost a bad investment to be in, but have been a good investment from an investment return perspective. So how does that work? So if I'm going to bet on a sporting bet as an example, can I bet on a team, get the call wrong, the team loses, and still make money? Well, the short answer is you can. You can either bet on an outright winner when you're betting on a sporting bet, or you can bet on the spread. And let me give you an example. For those of you who've been living under a rock, Sunday, 5:45, you better be watching your TVs. The Springboks are playing Scotland. This is a really, really important game for 2 reasons. One is we're in the group of death, and if we don't beat Scotland, we might not go to the quarterfinals. The second reason is I've paid to go to the quarterfinals, and if I get all the way to Paris and South Africa aren't playing, I'm going to be really, really, really cross. Now, the way it works right now is the odds are actually in favor of South Africa. The bookies have currently got the odds of 1.2 to 1 in favor of South Africa. And despite all the South Africans in their team, Scotland are going at 5 to 1 odds. The other way to look at it, though, is actually the spread, the point spread is expecting South Africa to win by 11. It's actually 11.5 this morning, which ironically, by the way, is roughly the yield of the All Bond Index at the moment. And I'll come back to that in a moment. Guess what a coincidence. But what this actually means is that the markets are thinking, the betting markets, which are incredibly efficient, they're more efficient than financial markets because the outcomes are more predictable, they're more binary. They're basically thinking that South Africa are going to win by about 11 to 11.5 points, and they think that Scotland are going to lose by 11 to 11.5 points. What this actually means is you can bet on Scotland losing and still make money, okay? And you can bet on the Springboks winning and still lose money. So if you're going to bet on the Springboks today, and this is probably actually not a bad bet if you're going into Sunday. This isn't a tip, by the way. It's not financial advice. It's not a tip. But actually, I would say, Scotland might, I think, lose by less than 11 points on Sunday. So what's quite nice about that is I can bet on Scotland, but I'm still betting on them losing, so I don't feel bad. I'm not actually betting on them. I'm just betting on them losing by less than expected. And this is very, very similar to financial markets. It's not about getting the macroeconomic call right and what's happening with SA inflation, the SA economy. It's largely about the real success in investing is finding out what is factored into the price at any given point in time. So even if what happens now, because the betting market's efficient, if we flip those odds around and we said South Africa is now expected to lose by 11 points, and I think South Africa are going to win. In other words, the most probable outcome is South Africa winning, and the odds are factored in as though they're going to lose. That then becomes not only a good bet, but a much safer bet. And that is exactly what we're dealing with right now, we believe, with South African bonds. So South African bonds are yielding All Bond Index 11.5. The longer dated bonds, we bought some longer dated bonds yesterday at 12.72. That means we bought a 20-year fixed deposit at 12.72%. That's a very good return. So what's happened since 2019 after I told you, everyone, that they should buy bonds? Well, as I've said already, the irony is the only thing you could have done better was buy global equities in rands. So global equities have gone up in the last 4 years nicely, as we know, and the rand has depreciated. The next best thing you would have done would have actually been to buy our fund, really, strategy, which was invested into the bonds at the time. Because the odds were factored in our favor, it still played out well. And we've seen this consistently over time. If we go back over 7 years, since inception, when we started running the mandates initially then, 7 years, 5 years, 3 years, 1 year, we've actually been able to be, even though we've probably been the manager with more bonds than any other manager in the category, because the bonds have priced in the negativity, it's actually worked out in the favor of investors. And it's worked consistently over time. The combined mandate that we've run over the period is the top performing manager over that time and significantly ahead of the peers. And it's because we've been doing something different, not because we've just been making sort of trading type decisions. And crazily enough as well, I really think that the bond, if you want to get exposure to SA bonds right now, the All Bond Index is one of the worst ways to do it. There's better ways to do it, and we've seen it quite consistently over time. The All Bond Index is a very narrow index. I'm just going to pick things up a little bit. Why have we done well? Well, we really looked for opportunities that give us a better return than the All Bond Index. Our exposure to the All Bond, if we had just invested our bond exposure in the All Bond Index, it would have resulted in 3.5% less return over the period that this is the last 2.5 years of the fund. Then in our credit space, we've added about 3% in that space as well. So really the key here is to be active and to look for opportunities. Now, what does that mean? That means when interest rates are low, don't fix your interest rates. When interest rates are high, fix your interest rates. And that's what we're seeing right now. We're seeing interest rates effectively, bond yields are, we bought some bonds at the end of May, and then like some of the bonds we bought yesterday, that's the highest we've ever bought bonds in South Africa. Okay, the last time you had interest rates even close to that really was like 1998, and I'll show you right now. So we've been quite dynamic. As the name suggests, we've pretty much tripled the amount of fixed rate bond exposure in the portfolio over the last year and a bit since the Ukraine invasion. And the last time our exposure was as high as this, ironically, was just before Ramaphoria started. And we look at the yield. Well, what's happened? Our yield has gone up quite dramatically. So if we go back to February 2021, the yield was just under 8%. As interest rates have become higher, that was the best we could really find at the time. We were being quite conservative. We could only get around 8% yields out of the interest rate instruments that are available. Now we're getting just over 12%. It's the highest the fund has ever been, which means that we've done well over the last number of years, but the outlook for the fund from here at the end of the day is largely driven by the interest you get. If you want to know what an income fund is going to do for you, look at the current yield. The current yield is the average of all the instruments you're holding in the portfolio. And right now, the average yield is the gross yield of the portfolio. That's not even an annualized yield, is just over 12%. Now, 12% is a powerful number because at this level, that's better than you typically get out of stock markets, as I'll come to in a second. What's the outlook? Well, the markets are factoring in and have started factoring in quite quickly rate cuts. Rate cuts I think pretty much everyone might disagree as exactly when rate cuts are going to happen. I think everyone agrees that it's highly unlikely we have further rate hikes. And what you want to do when rates are starting to come down into the future is you want to fix rates right now. Who in the audience here has got clients wanting to buy fixed deposits right now and lock in fixed deposit rates? Well, what we do is we're holding like a portfolio of fixed deposits, 20 years all the way down to short dated with an average yield of around 12%. That's better than anything you're going to get in the bank, but with proper liquidity as well. Bonds, you want to buy bonds before rate cuts start happening. And historically, when you've bought bonds before interest rates start coming down, it tends to be very profitable. It's not rocket science. You want to fix rates just before rate cuts start happening. And also, we're in a very different interest rate environment. If you look on the slide here, 2001 interest rates were 13% the repo rate. 2008, the repo rate was 12%. The repo rate's 8.25% at the moment. When the last time interest rates were 12%, bond yields were giving us between sort of 7 and 8%. Now we've got a situation where bonds are giving us over 12% in the longer dated bonds and interest rates are 8 and are likely to start coming down. And historically, if you've bought bonds at high yields, you tend to do better. It's not, if you buy a fixed deposit at 7%, your return is going to be close to 7. If you buy it close to 12, it's going to be close to 12. We've seen that quite consistently. But most importantly, we've hardly ever really had bond yields at this sort of level. There's only been 1 or 2 times. And historically, if you've bought bonds, the All Bond Index, which again is an index we believe is very beatable, if you've bought the bonds between 11 and 12%, your average return has ranged between 16 to 17% over the next 2 years. Now, that's not a guarantee. But what that means is off a yield of 12%, a good return for us will probably be close to 16 or 17. If we're wrong and interest rates don't actually stay quite high or start going up, you're probably getting a return closer to 8%. If interest rates stay the way they are, the yield that you get from an income portfolio is like the fruit coming off the tree. It's not about capital growth. It's about the income you're going to receive. So at the end of the day, the yield now, this is actually slightly out of date as the yields have gone up over the last month or so. We've increased the fixed rate bond exposure to just under 50% of the fund right now. The yield, as I mentioned, is just over 12. And really at the end of the day, the odds are stacked in the favor of SA bonds. Pretty much, we believe that even if bonds lose, in other words, the environment is bad for SA bonds, you still should be fine. We've seen it consistently over time. If you're invested just before Nenegate, just before COVID, 12 months later, you're up 7, 8, 9%. That's a bad return for these sort of levels. A good return will be significantly better than that. Importantly, this is an equity type forward return that you're talking about here. The whole reason we go into equities, if the starting point of why investors moved out of bonds 70, 80 years ago in pension funds was because bond yields don't give you enough return. But when bond yields are yielding inflation plus 7, inflation plus 8, that is better than you expect over stock markets at the time. So your biggest decision here is not bonds or income. It's actually how much equities you should be holding and how much you should be taking into other markets. Anyway, bonds are less, the more volatile bonds are actually less risky because they got much less credit risk and they're much more liquid as well. And really you need to take, we say a dynamic approach. We don't invest in property. We don't take on foreign exchange risk. We don't mess around with that. We're just trying to generate the highest return possible. And the outlook from where we are right now is pretty much the highest it's ever been going forward. So we're very, very confident. And he has a cheesy sort of punch on it. My mom eventually was able to sell her house. She's a widow, pensioner. Money's come available. There's not even a debate where this goes. She needs to draw down maybe 4% income. If I can get her 11 or 12% or even more than 10, it's a no-brainer. I don't need to worry about the rand moving. I don't need to worry about Pala Pala and other things. I don't need to worry about China and Evergrande. I just need to worry about a decent return that's higher than her income needs. Thanks very much.
Great. Thanks, Phil. Good morning, everybody. After 3 fixed income presentations already, I'm not sure if there's anything I can still add to that, in a sense, to be able to give you a perspective of what's really happening in bond world, if I can put it like that. And obviously, when you get yields to the levels that we're seeing at the moment, then generally speaking, you see bond fund managers are pretty happy because the sort of returns they can offer are fairly attractive. So what I'm really going to try to get, sort of answer in a sense is perhaps 2 or 3 questions here. The number one would be, why are bond yields so high in the first place? In a global context, it's not just South Africa. We're talking about a global context. And then in that global context, where does South Africa fit? And whether actually investing in bonds at this point in time is a good decision. Because, as Phil said, sometimes you do get things a little bit wrong in terms of the timing. So think about it. A year and a half ago, people in the US were buying 10-year bonds yielding less than 1.5%. For 10 years, you'd lock in a return of 1.5%. So the question is, what happened to make things wrong for those investors? To the extent that now you can perhaps even buy bonds closer to 4.5% for the next 10 years. So we basically want to sort of take a step back and just sort of say what is actually happening. This is the VIX index, which is a measure of volatility. So it actually incorporates a whole bunch of different indicators of volatility into this index. You can see that volatility is also volatile. So what I've done is I put the moving average through it in terms of the red line to smooth that volatility out. And you can see that there are sort of 3 distinct periods here, big picture events happening. One around sort of 1998 to 2002. That's the first one. The second one, 2008 global financial crisis. The third one, let's call it the COVID and post-COVID period. And what we're looking at here is some sort of transition. So these are big events that shift markets. So if you think about around about the 2000 period, yes, it was the tech bubble bursting. And then, of course, it set the scene for the bull market of tech going forward. But there was a couple of other things happening at the same time in terms of that volatility, the rise of China and so forth, emerging markets, the end of inflation as we'd known it in the previous years. And that really set the scene for what we actually now with hindsight call the beginning of the Great Moderation. And it actually set the scene, of course, for the risk-taking behavior that led to the 2008 crisis in terms of, we know, in the housing market in the US. But from the 2008 crisis onwards, what did that introduce? A period of 0 interest rates as well as negative bond yields. I mean, again, for bond fund managers, fortunately in South Africa, we probably will never in our lifetimes get to see negative bond yields. But it's a rather sort of interesting concept to sort of be able to go back to your bond investors and say, we did really well because we lost 0.5%, but don't worry, the market lost 1.5%. That would be not something we'd like to report on. So the question would be, the current set of circumstances that we've got post-COVID, what comes after? And we don't have to forecast what it actually is. What it really speaks to us is that embedded into asset prices with that unknown that lies ahead is higher risk premiums. That's the bottom line. So if you're starting to think about across all asset classes, what do you have to factor in? It's higher risk premium across all markets. So if you look at markets through these transitions, if I look at 1998 to 2003, you can see there's some big swings, both in the equity market, the bond market. I won't go through all the detail. 2008 financial crisis, we can see, in the equity space, 50% down. Also, big shifts in the bond space as well. And then the most recent one as well, more sort of on the bond space, upward moves in terms of volatility than downwards, as we well know. And maybe that gives us a clue as to what comes after this post-COVID crisis. Because if the bond market the volatility is more to the upside than the downside, it's speaking to the fact that most likely it's an inflation story. And this issue around, does inflation get back to the norms of the past? So I think the lesson learned from these transitions really is there'll be a lot of volatility across all asset classes. And that requires an inherent risk premium. I think I side probably with where Phil was going around the odds in your favor. If we look at it from an asset allocation perspective, if you look at the bond equity ratio, certainly at the moment, if you think about valuations in a global context, definitely it favors the bond space at this point in time. Again, and this is that, where we are at this point, and so certainly from a fixed income perspective, it is conducive to better returns. We know about this peak of the interest rate cycle. I think most of the panelists covered this. The expectations are there. If you look at the left-hand panel, you can see that's the Fed funds rate from that zero interest rate environment up to where we are today in this attempt to crush inflation to a certain extent. But there's something else happening at the same time, which is that it's not just that interest rates have gone up. It's also, in terms of feeding through into the real economy, is that this supply of credit, the taps are also being shut. So what you're seeing is banks basically saying, well, in a higher interest rate environment, we want to basically tamp down our risks as well. So we're going to stop lending to the sort of the marginal guys out there. So that switching off of the tap of credit also has an impact. And it's actually what really leads to economies slowing down, inflation basically starting to fall away, and also those whoopsies when things go wrong. So whether it's a Credit Suisse bank or whether it is a Silicon Valley bank or whatever the case is, that combination is really the thing we have to keep at the back of our mind, which is, it's what we almost sort of want to say is a sort of a black swan type of event. So when you've got credit rating downgrades, which is leading to higher default risk, as well as these shifts in monetary policy, because central banks don't always get it right. So when they try to read what they're supposed to be doing, and a lot of them use that terminology when they don't know, of saying, we're data dependent, we'll wait and see. So you can see the picture I put there as a black swan. You don't know where something's going to break in the system, and you can't forecast it. That's the definition of a black swan event. The point would be that if you have a black swan event, whether it is China, an Evergrande, or whatever, Japan, or whatever the case is do you have the ability then to shift quickly? I think this is where it comes down to liquidity risk, managing liquidity risk within a fund. It's not about sitting in cash. It's actually about the ability to shift quickly, depending on what that black swan event is. So here's the peak of the cycle, in a sense, where with the Fed funds, you can see from where we've come from. And again, the point I make about these shifts in monetary policy, the last time there was a big inflation surge going all the way back into the late 70s, and then the Federal Reserve decided, right, it's time to crush inflation. And they pushed interest rates up, you can see on the panel there, to 20%. And they kept it there for less than a year. And then they started cutting rates. Why? Because they started crushing the economy. And so then the problem is that they cut rates too early. And then they had to basically pump rates back up to 20% again. And this is the lesson that the Fed has learned. And when they are looking at it today, they don't want to make the same mistake of having to cut rates too early. So I think the point that we left with here is that, I reference this, and it actually comes from one of the Bank of England economists who actually said the central bank's preference at the moment is for almost a Table Mountain-shaped approach to monetary policy this time around, which is up, flat, and then down, not the Matterhorn, which is sort of up and then down, straight down. So I think it's a much more cautious approach. And again, from an income investor's perspective, it does mean that interest rates are going to remain on a global perspective at significantly higher levels than what we've seen over the last couple of years. And so certainly that is a great opportunity for any income investor. Sorry, I went backwards here. I suppose one question would be, well, like these black swans, and I'm going to cover like two that really worry the market. The one has been the US being downgraded from AAA to AA+. So is this the sign of higher default risk and so forth? And I think the market itself actually answers that question, which is this is actually the credit default swap rate for the US government from a sovereign perspective. So that's really a measure of default risk. You can see the big spike that we had. But look at the timing, which is the early part of 2023. So that big spike was related to those debt ceiling negotiations that they had in the US. Subsequent to that, you can see it's like flatlining. So the market has looked at the downgrade and sort of said it's irrelevant in the sense of the US remains, in a global context, the preeminent and deepest capital market in the world, regardless of whether there's going to be some BRICS currencies and things like that, which is, a story for another day. And then the other one is Japan. So the big news over the last little while, you've seen Japanese bond yields rising, and this was always the trade-off. If you shorted government bonds at, let's call it close to 0%, which was where Japanese government bonds were, it was called the widowmaker trade, because you always lost money. You could never win. And finally, the market's cracked, and so now you can see people have lost money or made some money on shorting government bonds in Japan. But here's the interesting notion of this, because there's a bigger story to this, which is the panel on the left, which is their debt to GDP ratio. And you can see that, okay, there's Venezuela at the top, but you've got Japan just below that, which is one of the most heavily indebted nations on earth. And yet, nobody have thought Japan's this big credit default risk, right? And why? Well, the answer is actually in that right-hand panel, which is the cost of their debt has been close to zero. I mean, ultimately, that's what a bond yield is, right? It's the cost of funding for a government. And so when you start to see, finally, the cost of funding for Japan starts rising, then you should perhaps start saying, wow, well, they've got quite a high debt to GDP ratio, way more than what South Africa has, and certainly a lot higher than where the US sits as well. And so, it's a relevant question going forward if the period ahead is cost of funding or bond yields is going to be significantly higher for a longer period of time. Okay, so let's turn to South Africa. We've seen this before from the other panelists. Bond yields in South Africa, 20-year highs. And the question would be, let's go back to the causality of saying, okay, it's the highest levels in 20 years, but maybe next year we might be saying it's the highest levels in 21 years because bond yields went up from this point in time. So you have to think about, well, what drove it to where it is today? So I've touched on the big macro perspective, and that's part of the story. Probably the more relevant issue here really is our credit rating, which is that judgment of our willingness and ability to pay our debt. And you can see the story, unfortunately, it's a downward one. Now, again, it's also sort of, this is a thing about correlation and causality, but I think this one's quite strongly in that causality side of things as well. Although, again, there's a lot of correlations as well. You've got to look at what's going on in the rest of the world at the same time. So when we look at our peers, rather than just South Africa, one of them being Brazil. Now, Brazil, generally speaking, and I've got their credit ratings there, so it's South Africa on the left versus the Brazil credit rating, and generally speaking, over the last, what's this? This is about 12 odd years, South Africa's credit rating, and even if you go back further, South Africa's credit rating has been better than Brazil's, higher, which means our cost of funding should be lower than Brazil, generally speaking, all else sort of being equal. And for the first number of years in this panel, you can see that's been the case. Brazil bond yields less South Africa is a positive number. You can see that. But remember, all this time, through this period, South Africa's credit rating and Brazil's has been falling. It's funny that they also form the part of the BRICS as well. So I'm not sure whether BRICS actually is good for us or not. We'll leave it there. But you can see more recently, of course, and in particular the last little period, is that the spread has now gone negative. In other words, Brazil's bonds are trading below ours. Brazil, a country that's defaulted on their debt multiple times, trades at levels below ours. So this is where I start saying is, look at the macro picture, look at what's happening in South Africa from a credit rating perspective, and then look at us relative to our peers. And what it would appear is that, yes, there's a reason why our bond yields are higher, and the 20-year highs. Number two is, in a South African context, yes, we can see why this is the case, but it's probably gone too far. And that is probably where the opportunity lies for us in the medium term, is that probably this, between our peers, there's possibility for us to see some sort of a pullback. I think the other panelists have cut the rate cut cycle. I think I agree with that. I'm not going to spend time with that. But I think if I put it together, this is really sort of a summary slide in terms of, the issues around heightened volatility, a macro transition, the recession risk, the black swan events, South Africa's idiosyncratic issues, as well as the inflation story. Put all of that together, and you can really sort of start to, create a narrative around a very powerful space in the fixed income relative to the other asset classes. And in particular, I'll just sort of highlight that the bottom really is that we're not calling for a new bull market in bonds. Rather, what we're saying is stability in this volatile band, maybe a little bit of a pullback closer towards our peers is the best that we can sort of hope for going forward. So if I look at the scenarios in terms of returns, I know it's a bit of a very busy chart, but it's a sort of a 3 month, 6 month, 12 months. So focus on the bottom in terms of the different bonds at the top that are in the All Bond Index. And if I sum that all up into what do we expect for the All Bond Index, this is our bearish scenario, is you're looking at returns of around about 10.6%, which is actually still fairly positive. I mean, I can go and construct a really bad scenario where you can see, negative returns. But again, what are the probabilities attached to these things? Again, we're looking at it, what is the most likely? And then if you look at the bullish scenario, again, on the bottom, those highlighted numbers, you can see very solid digit. I mean, if I just look at towards the longer end of the curve, you're looking at sort of 19, close to 20%. But that's single bonds, right? So generally, remember, we're trying to construct a portfolio which would incorporate some of those, as well as the shorter dated or the floating rate, to blend it, to give you a return which is closer to what the All Bond Index would be around about 16%. So I think that correlates very strongly with what Phil was talking about, this equity type returns. Again, I'll just use a simple example here, is that if you think about, the very broad perspective of equity versus bonds, equity risk premium in South Africa generally around 7%. Added to the risk-free rate, you're looking at 15. So when you look at a possibility here, and this is not a core scenario, we're probably sort of in between, you're looking at 15% required return on equities in South Africa. And you're looking at these sorts of returns in the bond space. And so I think that really does speak to where we're getting to. Okay, so let me just bring it together in terms of a fund. You want to get, obviously, out of fixed income funds, you want inflation to be beat, you want lower inflation, lower volatility, you want the high income on a consistent basis, and you want to know what sort of risks are being taken there. If you look at the alternatives, you've got all share index in orange, you've got the yellow is the STEFI index, the money market index, in between is the all bond index. What our fund, the Sasfin Flexible Income Fund, tries to do really is quite a simple investment proposition in this space, which is ultimately this, which is that what we're trying to do is give you those all bond type returns, but with half of the volatility. So as less volatile as the all bond index is, we want to be half of that volatility in this volatile sort of period. And if I look at the numbers, in terms of that, you can see quite clearly the return on the vertical axis, risk or volatility on the horizontal. You can see the volatility is about half that of the all bond index. So it's a very simple proposition. Stick to the fixed income space. We don't bring in all the volatility of offshore, whatever. It's not to say it's not right, but we leave you to make that offshore call or the property call or the equity risk call and so forth. It's a pure fixed income building block, giving you those bond-like returns with, on average, half of the volatility of the all bond index. So in terms of those returns, you can again look at it. The gray bar is the all bond index. The blue bar is our fund. And again, consistently being able to deliver the bond-like returns with half of that volatility through time. So in terms of current positioning, you can see the top right. Duration of the fund, 2.8, just below that. All bond index, 5.8. Very simple rule of thumb. You can ask this question. If you want to know how volatile your fund is, you ask one question in fixed income space. What's the duration of the fund? So if we say it's 2.8, and you say, okay, what's the benchmark here? 5.8. We're half the volatility, because duration is a measure of volatility. That really just tells you what you can expect going forward in terms of the underlying volatility. The spread of investments, again, at the bottom there in the table, I won't go through the detail as I'm a little bit short of time. But again, just to illustrate, what sort of risk do you take? Because I think, again, in terms of being active through a cycle, it's not about using just one lever in fixed income. It's about adapting as the market changes. So if I look at the credit risk spectrum, over time, if I look from the left 3 odd years ago to where we are today, a clear shift away from let's call it the lower rated credits. And it's not about saying we think it's going to be defaults. If I think about, Monica, what you were touching on, it's not about us saying, oh, we think there's going to be big defaults or whatever the case is. All it's about saying is when we come back to what does the label say on our fund? It says bond-like returns with half the volatility. So that's what we're trying to do here. Is I can get bond-like returns without going into the credit risk space. It's as simple as that. It's not about saying we're going to maximize the return of bond-like returns, hopefully a little bit more, but I don't have to go all the way down that spectrum because where bond yields are and because of where we expect them to go over the next little while. I think the forgotten risk, of course, is the liquidity risk. So again, what we do is classify instruments into their tradability. So again, when you look at a shift away from those credit space over the last couple of years into where we are today in the top of the cycle, you can see the ability to shift, if there's a black swan event or whatever the case is, clearly there within the fund. And I think that's probably where my last slide really is. In terms of those bearish, bullish scenarios, we're probably somewhere in between as far as a base case is concerned. And so we're expecting a return in this space then to be around about 11 to 12%. And I've sort of highlighted at the bottom, it's a little bit more if South Africa and if inflation behaves. Thank you very much.
So much passion from fixed income managers, isn't there? You can feel the love. I think that cell phone that rang is to remind us it is tea time now, but you need to give me 2 minutes. One question. Tian. Yeah, we get it. It's almost tea time.
Hi, it's Tian Free from Responsible Capital. Yeah, it's awesome to have bond managers on stage because they actually talk the truth, okay? Because they have the numbers to prove it. There's one comment that I want to make. The equity guys often talk about how, equity premiums will dissolve and we will get the returns. We've heard that story for 20 years. Equity risk premium doesn't necessarily come through. It sometimes does and sometimes does not. Okay. Where bonds, the premium is through duration, it gets dissolved and it gets paid to investors. So that's the one major difference when we talk about expected returns on equities versus bonds. In bonds, you get paid cash every year to ensure you get the return. In equities, it's sometimes figments of imagination like Steinhoff. The one question I have around the bond exposure, and this is the interesting thing, have we understood where the premium comes from? Because what we tend to do is, as South Africans, we depend on the professional investment market to extract or to arbitrage away the premium that exists. But the problem we have is, the greatest beneficiaries of the mispricing is the banks and the life insurers. And these people are in cahoots with other people to ensure that premium remains elevated because that entrenches value to them. The investment managers have the responsibility to ask questions of that. And it almost seems like we haven't. Because how is it possible that a country like Brazil, that is an absolute shithole in shambles, can't collect its taxes, and it has a massive economy? How can that country be rated better than ours? The reason is simple. Most asset managers sit on stage and tell people lies around the idea that buying bonds is supporting the SA government. Buying bonds backs people in this room. It's about the SA taxpayer. So when you buy bonds, that's what you're doing. Can we please stop lying about the idea that we're backing the government when we buy bonds? We don't. We back ourselves. And is that not time for us to start saying, hang on, if the return on bonds is between 10 and 16%, every single person in this room should stop buying hedge funds, should stop buying offshore, should stop buying anything stupid and put 50% in bonds, because that's what the data says. The empirical data backs that up, where it says that few balanced funds in this country has managed to outperform a simple 50-50 portfolio with no credit enhancement. That includes all the branded balanced fund managers and the ones that won the Raging Bulls and all kind of other awards. Please, we need to find a way to understand where the premium comes from. The current narrative doesn't cut it.
Yeah, Tian, thanks for that. We're trying to find the question in that statement. Right. But I'm gonna park it there. You can have a discussion over tea time outside if you really want to with any one of his managers. I've got one very quick question, and I was very fascinated about the argument on global bonds, Nolan, that you include. I mean, if you look at global bonds, yields about 4.5%. You've got currency volatility that you do hedge out, but it's going to cost you money. SA bonds about 12.5, give and take, depending on what you buy. Fool's buying your stuff a little bit higher. Why global bonds?
Hi, am I on? Yes, I'm on.
Yes.
Hi. So firstly, when we're currency hedging, yes, you currency hedge your global bonds. Otherwise, you end up with your bond portfolio just does what the rand dollar does. You're actually being paid, and you're being paid quite handsomely at the moment. So you're taking a sort of 4.5% bond, you're turning it into about an 8.5% type yield, give or take, at the moment. Less than South Africa, but what you're doing is you're isolating, if you want, out that South African risk premium, because the challenge here is that the South African risk premium has just been pushing upwards and upwards, as Arno's chart was showing, as the credit ratings go down and down. And that's a lot of the premium. So as that trend has been going, and we can argue how fast that trend's going to go and how much further South Africa could deteriorate and how far the premium is going to go up, that's going to counteract the benefits from interest rate cuts, from global yields coming down, from yields coming down. So what we're saying is, to the extent we want to position for yields coming down, let's isolate that in a more pure instrument, and that we're finding more in the US right now, where you can kind of lock in potentially that benefit for the longer period, potential capital gains down the line. That's what you're investing for there, but you're not exposed to a lot of the sort of South African idiosyncratic risks, and that's something that holds a lot of appeal to us at the moment.
Very interesting. Philip, you want to add to that?
And I think we kind of doing the same thing in some of the strategies as well. It's all about trying to generate the best rand return. But what you can do, let me give you an example. If Standard Bank borrows in South Africa, they're going to borrow at a very close spread, sometimes even below the government when they're lucky. When they go into London and they want to borrow in dollars or euros, they go, Standard Bank who? So they're forced to pay a wider spread. So no one's going to give. So what you can actually do is you can go and buy a Standard Bank bond in dollars. You hedge out the currency back to rands, and you actually get a higher return than if you'd bought it in rands. So the trick here is to say you can do that with South African governments as well. You can buy a South African government in foreign currency, hedge it back, and it's just one of the mechanisms. It's one of the opportunities that we'll all probably take advantage of as well. So, but at the end of the day, your return is in rands, and the big thing here, it's called the carry trade. Cash and carry is the terminology. You borrow cash in a low interest rate, and you invest it in a high interest rate. And what you're doing in that instance is when you hedge currency out, you're swapping from a low currency interest rate to a higher interest rates in a currency like South Africa. So you're taking advantage of the carry trade. So you can turn a foreign credit into a local return very easily.
Makes a lot of sense.
Can I maybe add something to that?
Yes.
There is a sort of an addition to it, if I may sort of add it, which I think Nolan sort of touched on. If you take a US Treasury and bring it into South Africa, the one question I'd ask would be, who's giving you essentially that currency swap? Because it's probably a South African bank. So if South Africa were to go default, you can't say, don't worry, I've got US Treasuries, it's fine, because the bank's probably going to be down in the drain as well. So there are some hidden elements there. I mean, I know it's a small risk as well, but you just need to maybe just say, if we do go into the situation where South Africa defaults, we're going to be in, the banks will also be in trouble.
Well, then we'll all be in trouble with lots of other things as well. Well, exactly. Monica, very last one from your side. Something that you would look at is global credit. I know you like credit,
Yes.
but you guys look at global credit as well?
So we do. We will only invest in names that we cover in in-depth credit analysis. So it would be our SA Inc. names that issue an offshore market. I think Phil mentioned the likes of your Standard Bank. So it's your miners, your banks, and some other corporates, the likes of Bidvest, that issue an offshore market that we would take advantage of.
Makes a lot of sense. We're unfortunately out of time. I hope you guys stick around for tea. There's got some nice snacks and stuff as well. So if you want to have any questions for our panel, you're more than welcome. Ladies and gentlemen, thank you so much for being here today and your time. We really appreciate it. We are going to break now for tea. I see you want to go. We can, if I can ask you if you can be back here at 12. We're going to try to start about 12:05. So quick tea, leg stretch, and a cigarette for those of you who want. Thank you. Right, guys, we are about to start. If you can maybe settle down. Right, let's get going. Our next session after tea, SA Property. We've had a very good session now earlier this morning with Andrew from the Redefine Group, giving us a good introduction or view on SA Property. Good valuations at the moment. I think it's a very hard story to sell to clients. If we look at returns over the past 2 years, obviously very disappointing. But is this maybe the time to start looking at SA Property again? And here to share the views with us from Sesfikile, Naeem Tilly. Sesfikile Asset Management that only deals with property. They also manage global property, but they eat, breathe, and sleep property, so they're probably the experts when it comes to SA Property. Naeem, thank you so much for joining us here today. It's really great to have you here, and the floor is yours.
Cool. Thank you. I think it's fair to say if that was the quality of tea, we're all looking forward to lunch. Okay. I'm going to start off by giving you a little bit of a flavor on what you invest in when you invest in South African listed property. Geographically, half the assets are located offshore, and I think this is particularly important with a significant amount of money going offshore due to Reg 28, whereas about 48% of our exposure is still located locally. We actually getting excited about the local environment, but there still remains a lot of growth opportunities within Central and Eastern Europe, which I'm hoping to talk about a bit later, and then more stable markets such as the UK and Western Europe making up about just under 20%. From a sector point of view, a lot of negative headlines around office right now. I'm here to say that office accounts for 15% of total exposure, so it's not that much. There's about 3 or 4 companies there where it's concentrated. So, for example, Growthpoint, Redefine, and Investec Property Fund. We are underweight all 3, so we do have this opportunity to reduce our exposure to the office sector. But what really matters for us is the retail sector. It accounts for just less than 2/3 of total exposure. Retail, for us, has been actually seen amongst the best recovery rates that we've seen across to all 3 sectors. So, for example, vacancy rates are sitting at almost at record low levels. A lot of underperforming retailers in the last few years have been weeded out in part due to COVID. That vacant space has been absorbed by the likes of Shoprite, Mr. Price, the Foschini Group, and a lot of mid-market retailers, which really saw this opportunity to actually take market share when vacancies were starting to increase. So vacancies have been absorbed and now currently sitting at just about 3.5%. Rental growth is something that has been an issue for the retail sector, mainly in the larger shopping center formats, partly because of COVID and the impact it had on restaurants and entertainment. But what has happened subsequently is that we've seen this massive recovery, firstly driven by the lower vacancy rates, but people returning. People are getting back to going to the cinemas, going to restaurants. Food retail is on the rise as well. And that has all led to rental growth starting to pick up. On the top right-hand side, you'll see that the mustard line showing that rental reversions are now starting to tick up, and it's down now only 5%. Now, remember, when I talk about rental reversions, this applies to about 1/3 of your portfolio. The rest of your portfolio is still growing by a contractual 6 to 7%, which is agreed with the lease based on the lease term. We are aware of the falling consumer confidence and weak retail spending. It is something that is been driven by high inflation, high interest rates. Encouragingly, the Reserve Bank said that we should still see positive or real positive wage growth in South Africa. We have quite a resilient consumer because some of the level of indebtedness is far less than maybe some of the markets globally. And I think that we could come out of this a little bit better. But what is affecting most of the retailers today is load shedding, and not just the retailers, in fact, all sectors right now. Electricity does account for about 14% of an average retailer's overall cost of occupation. And this is normal electricity. When you put in diesel costs, that goes up by about 5 times. Not the electricity, just the portion that you're using. Diesel is about 5 times more expensive than using electricity from the grid. From a landlord's point of view, you can see in the bottom left-hand side that most of this diesel cost, this added diesel cost, is recovered. About 50 to 60% of all the cost is recovered. There's a lot of common area space, and some of the parts you cannot recover from the tenant. Ultimately, the impact is quite small. It's about 1 to 2% of earnings. The bigger issue is how long does load shedding stay at stage 6, and what that means for many of the retailers in the longer term. The silver lining is probably the one in the bottom right, the chart in the bottom right-hand corner. where due to load shedding, a lot of the companies have actually accelerated their renewable projects, renewable energy projects that were planned to be spent over 7-8 years and now are trying to cramp it up into the next 3 to 4 years. Resilient property is a good example where they're spending R1 billion within the next 2 years. And the Redefine is another one. You spoke to Andrew earlier today. Similarly, across the sector, this means, and together with the private sector, that we could see the unmet portion coming from the grid being quite a small component within 2 to 3 years. The added benefit is the rollout of renewable energies at yields of about 15%. So for most of these property stocks, not only are they ensuring that the tenants can operate through load shedding, they're also getting a return which is well above what funding costs are right now. So it's actually an opportunity to enhance earnings. The office sector, which we touched on briefly at the beginning, it's a sector which has seen vacancies rise. We all know the impact of what work from home had on the sector. The economy has been weak, so there's little new demand. But I'm happy to say there's been a little bit of a stabilization, and in some parts, actually a little bit of recovery as well. So you can see in the bottom left-hand side, we're looking at vacancy rates. The typical type of quality of space you get in a listed sector is P or A grade space. So P really being the flashy buildings in Sandton, mainland as well. And there we're finding vacancies actually fell from 12.8% to 9.2%. So where is this demand coming from? There's a few reasons. One is load shedding, ironically, has meant that a lot of corporates are saying, employees, if you don't have electricity at home, you need to come back to the office. So there's a lot more certainty. They're signing the lease terms based on the fact that now more employees are coming back to the office. The second one is ESG. If you are sitting in an A-grade building, you don't necessarily have solar, you don't have the most modern aircon systems, your electricity and overall cost of occupation can be fairly high. Once you consider, even if you move to a more expensive premises in terms of your rental, what you save from a solar point of view and water harvesting and more modern air cons and so forth, means your overall cost of occupation can be similar or if not less, but you get in a much better premises. And that has meant a lot more people are moving from the B and A grade buildings towards the P grade facilities. Another recent development is the BPO sector in South Africa. So Philippines was a major market, and in the last few years, unemployment is quite low. The cost of labor in the Philippines is starting to increase. And so these global businesses starting to look towards South Africa. We found that the vacancies in Cape Town have fallen. Firstly, the reason why Cape Town is because labor rates are lower, and there was a much better environment for workers, so they decided to go for Cape Town. Durban has been a beneficiary now, and now that spillover is even coming to Johannesburg in places like Parktown, where it's not a major office market, are starting to see good demand come through. So there is life in the office sector. I'm stopping short to say we are on the up and up in the office sector, but there's definitely has been a stabilization, and no longer rentals are falling to the same degree as they used to. The industrial sector globally has been on the rise. The reason e-commerce globally, but locally also because of something called supply chain optimization. Just a fancy way of companies saying we want to consolidate over 3 or 4 warehouses into one bigger facility, closer to the labor pool, closer to the highway. Transnet is a major issue, so we need to be closer to the N3 or the N1. And as a result, our overall cost of logistics reduces. That has driven a lot of demand, a lot of obsolete warehouses coming out of the market. And for the first time now, what we are seeing is an increase in your rentals. So for some time, rentals weren't following. Good demand, good letting, rentals staying flat, but now building costs in the last few years have started to skyrocket. And as a result, your rentals asking for new premises are starting to increase. And hopefully the bottom right-hand chart sort of captures it. This was by Equities Property Fund showing you that rentals are starting to now ask from 65 last year. They're now asking at 75. Some of the major nodes like Longmeadow in Johannesburg, even in Waterfall, are pushing towards 95, even 100 rand a square meter in Durban. So there is still really good demand for industrial space, and rentals are starting to follow as well. So that captures sort of the local property market. I want to talk about the balance sheet, and this is a tough one because the fundamentals look good, but there's a lot of concern around interest rates right now. So firstly, on an indebtedness level, the LTV ratio, which is basically the value of your debt to your value of your assets, so the debt to assets ratio, has actually been falling. So we found asset values fall during COVID. Companies were very proactive. They sold assets, they retained income, and that LTV has actually fallen to 37. Your covenant levels are between 50 and 60%. So there's no real concern that any of these companies are going to default on any of the debt whatsoever. The concern comes in a chart in the top right-hand corner. They entered the cycle of higher interest rates actually very defensively positioned. The average amount of debt that was fixed, so not subject to what happens in the interest rate cycle, was 80%. We had 3 years before most of the debt expired. So on average, you would say these companies were well positioned for the rate cycle. However, unfortunately, the rate of change of interest rates, play on words there, but that itself caught up. And that small portion which was unhedged or vulnerable in the current market means that it will have quite a material impact on earnings. When I talk about that, we have it in our numbers. We've accounted for it. It takes about 1 or 2% of earnings. So when your top line is growing, some of that is getting absorbed by the fact that rates are increasing. I'm just going to skip that slide just for the interest of time. Inflation. So inflation has been high. It's started to come down a little bit now, but I think it's still quite important just to highlight the inflation protection offered by the listed sector. You can see firstly that over the long term, listed property has given you distribution growth of 5.4%. And over the same period of time, inflation has been 5.6%. So it's grown in line with inflation. Maybe a little bit less, but remember this includes a period of COVID where distribution growth was down by more than 20%. So if you exclude COVID, you can comfortably say the distributions were ahead of inflation. What gives us protection is that you've got contractual escalation rates with tenants, and that grows in South Africa by 6 to 7%. So regardless of what happens from an inflation point of view or cost point of view, you're getting 6 to 7% up on your rentals. The portion that expires per annum, that part is subject to market rental reversions. In Europe, remember we said Eastern Europe is quite a sizable part. You've got indexation, which means that inflation is 8 to 9%, which it was at the start of this year. Most of the tenants have actually had to pass, the landlords had passed through 8 to 9% with regard to interest, with regard to rental growth. So that has come through, and that's showing good numbers when it comes to Eastern Europe. The last point is actually quite important as well. We've seen a lot of pressure coming from utility costs in South Africa, municipal costs. Rates and taxes has been increasing by much more in inflation. Unfortunately, it's very difficult for the companies to absorb a lot of this, and we're passing it on to the tenants, but some of this means that the tenant sees an overall cost of occupation increases and does put some pressure on the top line. So there's a lot of work being done by SAPOA, talking to the different municipalities with regard to the rate of increase as well as evaluations they are proposing, and that's putting some pressure on the cost line, but the top line growth I think can absorb some of that. It's cognizant of time. The reason why we're still quite excited on Eastern Europe is because of those measures in the top left-hand corner. If you look compared to South Africa, Romania in this environment is still showing 2.5% GDP growth in real terms. Poland's a bit less, it's just under 1%. Wage growth, 15% in Romania. That's the most recent data point, I think it is in June. Poland is showing 10%. Yes, inflation is high, but remember the wage growth is also driven by the fact that you've got unemployment at 5.5% and 2.7% respectively in Romania and Poland. Now remember, the reason why unemployment is so low is because you've got all these Ukrainian migrants that have come across the border, and as skilled laborers have found jobs. A lot of the Polish, especially, and Romanians that have come from the UK following Brexit and have found jobs. So unemployment is low. At the same time, Western Europe is outsourcing a lot of their services to cheap labor pools in Eastern Europe. So that means there's wage growth and low unemployment and so forth. So we're quite encouraged by the macroeconomic side of things. Interest rates are an issue here, but as I mentioned before, they have high in levels of indexation, or inflation is high, so indexation is coming through, and that is offsetting a lot of the pressure from an interest rate side of things. Valuation-wise, listed property is offering you a yield, a spread compared to bonds, which is in line with the long term, slightly higher than the long term when you look at that purple line. The reason I there's two lines is one accounts for the fact that payout ratios have declined. But this is more exciting for us if you look at net asset value. And this is the value of the assets after having seen a write-down during COVID. We're sitting at 36%. Let's just round it here. 37% discount to net asset value. And compared to the historical numbers, it's nowhere close. The last time we saw something similar was during COVID, when, to be honest, at that point in time, most investors didn't know what's going to happen to the world in a year or two. So for us, valuations are discounts are quite wide, and especially if you look at a table in the bottom right-hand side, there's been recent transactional evidence to support current valuations. Attack, they sold 30% of the Waterfall precinct to the PIC or GEPF at an 8% discount to its GAV. GAV is the actual asset value. Liberty 2 Degrees sold, Liberty Group bought it out at an 18% discount to GAV. Industrials REIT was bought out by Blackstone. It's a UK business at a 10% premium to asset value. So this doesn't for us show you that a listed sector should be trading at a close to 40% discount when the private market is acquiring these assets at these valuations. I think a lot of the market is suffering from recency bias. And what this basically means, there's an overemphasis on the recent last 5 years, and it's understandable. We've seen 2018 where the sector was under hedge fund allegations, 2020 with COVID, inflation and interest rates now. We had a social unrest which had a proportionally more of an impact potentially on the property sector than some of the other sectors. So yes, the last 5 years were bad. You can see that in the chart in the bottom left, on the left-hand side, the blue dot showing that risk return was poor. On the right-hand side, and I urge investors look at the sector over multiple cycles from 2004, you can see it offered returns which were similar to equities and potentially a little bit higher volatility, but it had returns which what you'd expect from listed property over the long term through multiple cycles. Just to conclude on my IRR expectations or total return, we're looking for about 14% total return for the sector over the next 12 months. The large portion of this got to do with the dividend. The income is just short of 9%. This is should be given. The remaining portion, remember, there is a portion that's retained. This retained portion is for shareholders. This enhances your net asset value, so it's not lost. It's not a lost dividend. So 8.7% will be dividend income. We are expecting growth of just 2.3%. A lot of the growth is driven by the offshore markets. SA is a little bit slower, but remember I said the distribution growth in the long term has been in line with inflation, so we'd expect over the medium term to get to that 5%. So I'm fairly confident our numbers are very prudent. And then lastly, understand everyone has their own expectations or assumptions. If you look at the SA 10-year bond, our bull case, remember it's extremely sensitive what happens to the 10-year bond. If yields go up, the opportunity cost changes and investors will move from one asset class to another. Our base case, is 11% 10-year bond. If you think 10-year will go to about 10.5%, and the Bloomberg consensus forecast is roughly that, if you just look at that bullet point there, then you could see upside return to potentially about 20% should that yield spread also narrow slightly. So we're quite optimistic on the sector. We think SA is recovering. We've got good growth coming from Eastern Europe. There are headwinds, load shedding, interest rates. We got it priced in. We think the sector evaluation considers all these factors, and we're quite constructive on the sector. Thank you.
Naeem, thank you very much. Any questions for Naeem? Right, Naeem, maybe from my side, very quickly. I know you're more involved on the local fund. You seem to be very constructive on SA property from a valuation perspective. But on the global side, you run a global fund as well. Are you as constructive on global property from a valuation point of view, if you look at SA and global?
It's interesting because globally we are finding interest rates starting to peak. So it looks like rates, and again, it's so difficult to say what's going to happen in inflation and interest rates going forward, but rates, it looks like the rate cycle may start to peak with some expecting rates to start to drop. Historically, when you look at rate cycles, when rates start to fall or even sort of peak and then start to fall, it's very positive for property, global property specifically. So we're constructive. We just think the timing may be something a bit later towards the end of this year. A little bit more certainty on inflation. The interest rate outlook starts to become a little bit more certain, and I think that listed property will start to perform better. Geographically, if you want to know a little bit more, we're more positive on the US than Europe. Europe's balance sheets are worse, but US better balance sheets, and we think the economic growth, maybe for soft landing, but I think economically it will be much stronger as well.
Very last question, very quickly. Your benchmark, the SA Property All Property Index. We had a good presentation from Andrew this morning on Redefine. You've got other great property companies out there as well. When you construct a property fund, the SA property fund, I mean, how do you decide what percentage to allocate to some of these REITs? Is it more macro-driven? Is the starting point the benchmark, or how do you get to that answer?
So we are completely bottom-up. So I know when it was at a peak of load shedding, and there was a lot of money chasing companies like Nappy Rockcastle and Mass and all the offshore stocks, we were looking at it bottom-up. So we didn't hold, or we held underweight positions to the likes of Lighthouse, which was Western Europe. It met the currency requirement for offshore, but we looked at bottom up. We said earnings doesn't support it, and we'll value it as such. So we look at it company by company. We don't look at it geographically. We try not to. Right now, SA, or at the start of the year, SA was poor. We think it's starting to change. Offshore may also start to change now with some of the recent results. So purely independent of macro views.
Good stuff. One question there at the back. Yeah.
I just, on a slightly different tangent, do you see any risk of serious contagion from developed market residential property bubble starting to burst? I mean, we had a lot of stuff earlier this morning about the Chinese market, but there's a maybe slightly more subtle, there's a decompression in developed market, residential property, and because it's massive, and I think it's been such a almost over-invested asset class for decades now, driven by cheap interest rates. Do you see that sort of contagion risk, some, rather maybe not so obvious links?
Yeah, so it's a good question. There's two big residential markets globally that we can invest in. The one is Germany, and the other is the US. The US market is a very strong economy, and you know the story about the strong labor pool there. So house prices have actually started to recover. If there's a global house price issue, or at least in the US, then it will impact some of the REITs. Remember, these are rental businesses. So even if the value of the asset falls, if your earnings stream can still show some support, driven by your wages and low levels of unemployment, I think these stocks will be fine. We don't invest in any developers or home builders or anything of that sort, where it's a little bit more driven by the level of activity in construction. Germany is a little different because the companies are very indebted. They've got LTV ratios of 45%. The issue here is that you've got rates that may still go up a little bit more in Europe. You've got very little transactional evidence. So we're a little bit more concerned that we haven't seen the end when it comes to German residential. And I think I'd be more concerned there. I don't think it'll be a contagion effect, but I think it's more isolated to Europe and the house price, or rather the yields that they offer you in Germany. So not so much contagion risk, but specific risk to the economies.
Yeah. Naeem, thank you very much for that. Much appreciated. Right, if you want more information on Sesfikile, get hold of Amelia. They know how to get hold of the team. And like I mentioned as well, they've got a global property fund as well, and they're really the property experts. Right, we're moving on swiftly. Fairtree manages a mandate for us called the Fairtree Select BCI Cautious Fund. You're all familiar with Fairtree, very good asset manager, good with cyclical rotation as well. Chantelle unfortunately couldn't make it. You've all met her before. So we're going to have a quick screening of a video with comments or information on how Fairtree sees the world and the cautious mandate. I know Ryan Jamieson from Fairtree is around here. I don't know if he's still here, but if there's any more questions on the fund after the screening, you're more than welcome to chat with Ryan as well after lunch. Thank you very much.
Good afternoon. My name is Chantelle Baptiste. I'm one of the equity portfolio managers from Fairtree Asset Management. Thank you so much for having me this afternoon. I'm going to be presenting on the Fairtree BCI Select Cautious Fund, but I'm going to be focusing on the equity carve-out of this fund. I thought it would be very pertinent to chat about navigating the macro, which has been incredibly perplexing and difficult to unpack during the course of this year. And a neat way to do it is to look at covers of The Economist, which I find incredibly backward-looking, so it often states the obvious. Now, we started this year anticipating a wave of consumption coming out of China, moving off the back of last year with them unlocking their zero COVID policy and almost encouraging consumers to go out and spend. That has not come to the fore. So consumption has been there, but we've seen Chinese people actually sit on their savings and not spend. So it has been very, very disappointing macro data points that have been coming out of China. We've been very concerned about the US market. At the outset of this year, I would have said to clients, we are pricing in some type of softening, whether it be a hard or a soft landing, but markets keep anticipating good news. February came through and we saw the US regional banking crisis. And this gave us affirmation that, okay, finally something has cracked. The Fed stepped in and supported that, and we continued with new highs across the NASDAQ and the S&P 500. We've also seen a bit of a change in the world order, with the East rising up against the West. Again, confirmed last week, where South Africa housed the BRICS summit, and we invited 4 more additional nations to join us, a lot of those being very much oil-focused nations. We're starting to see pressure on the US, and a lot of these West or Eastern countries are also starting to put a bit of pressure on the dollar. We also have been talking about the secular support that ESG will be offering certain base metals, such as copper, zinc, aluminium, nickel, some of your rare earth metals. And that is just because of the quantity of commodities that needs to go into this renewable drive that we're seeing. With all of your key economies across America, the Eurozone, and China pledging that by 2050, the world will be carbon neutral. And there's certain ways that you can play that type of commodity intense infrastructure. And then lastly, our base case is that we think global inflation will remain higher for longer. Yes, it will come down, and it has been coming down, most pronounced in the US, but we don't think it's going to come down to the levels that the Fed is expecting. This is where we think we are in the global inflation cycle. So we have peaked and we're starting to come over, but we don't expect inflation to trough. The reason is because the transitory aspects of this have come through. We had a shortage of goods because of COVID, because of China locking down, and a lot of that supply side disruption has been solved for. You also had huge demand because of individuals sitting on a quantum of savings. The very basic definition of inflation is too much money chasing too few goods, and that has come through the system. What will remain supportive of inflation and pushing it higher is more structural issues. We have demographic issues with a significant global aging population and not enough youth coming through from a work-based perspective. You have wages which are remaining higher for longer to try and entice people off the couch back into the work environment, specifically across the UK and the US. You also have a lot of fiscal and monetary policy regime changes, and you also have deglobalization, which is very inefficient in nature and will support higher inflation. Lastly, housing is a key underpin to higher inflation, most pronounced in the US. And the reason for this is that a key component that goes into the US CPI basket is housing. What we're finding in the US is there's a shortage of houses, a shortage of stock available. That's for two reasons. Number one, during COVID, the cost of building new houses went through the roof because of the cost of steel, timber, labor. So not a lot of new stock was brought onto market, although the demand was there. Now, from an existing housing perspective, what you're looking at here is the black line is what you would be paying for your 30-year mortgage rates in the US. And the orange line is if you took out a new home loan today, what you will be paying. Almost double your current installment. And what that means is it's deterring individuals from selling their current homes and taking on new home loans and locking those home loans in at 7.5% over the next 30 years. So significant shortage of stock, both new and available housing. And this is pushing rentals through the roof. The mechanism that monetary policy is used to bring down inflation is to make sure that your key asset, being your house, becomes expensive from a monthly installment perspective. It kind of dries up your disposable income, and then you have less money available to spend on other goods and services, and that brings inflation down. So this monetary policy mechanism in the US has somewhat broken down. If we look at China, we're seeing the flip side of this, where you have individuals sitting on a lot of savings, very loose monetary policy, but they are not spending it. The orange line here is the amount of savings the Chinese population is sitting on, to the tune of about 19 trillion RMB, but they're not going out and spending it. Why is this? Because of the confidence crisis that China is currently sitting in. We haven't seen this level of confidence or low levels of confidence over the last 26 years. And that is because the trust in the Chinese government has considerably broken down over the last 3 years. It started off with huge regulations coming through, decimating their property sector, which had impact on the Chinese population. Then we went into zero COVID policies where individuals were not allowed to leave their home. Then we went into Xi Jinping pronouncing himself leader for life, ultimately pronouncing a dictatorship. And then suddenly we reopen, you have a lot of stimulus in the system, but the Chinese people do not want to spend. Remember, in China, the exchange policy is very stringent. It's very difficult to externalize your wealth or your assets. You've got to keep it within the country. So people are literally sitting on cash at the moment and they're not spending. What we've been anticipating is to get things going and to reach that 5% GDP level that the Chinese government wants by the end of this year. Some type of fiscal bazooka package, but they're not releasing it this far, and it makes it very perplexing from an investment perspective. We turn our eyes now to South Africa. We also remain in a bit of a confidence crisis, and arguably we have been here for some time. I've divvied up the JSE into your key avenues from an investment perspective, maybe oversimplifying it somewhat, but resources in black, offshore rand hedges, predominantly your dual listed space in orange, and in blue, a very unloved sector being SA Inc. Now, from a bottom-up perspective, SA Inc. is screening incredibly attractive. Some of these stocks trading at 4-5 times forward PEs, giving you a 7-8-9% dividend yield. Very, very attractive. But a bottom-down view, if you look at the macro, that's informing us, wait, we're still in the middle of a power struggle and crisis because Eskom cannot provide enough energy to the country. We've had the potential risk of US sanctions during the course of this year, and plus we're leading up to a 2024 national election next year. So a lot of uncertainty. If we tackle the key risk here, which is Eskom and energy, we believe it will be solved for from a two-pronged approach. Firstly, what government is willing and able to do from a capacity, a skills, and a balance sheet perspective. And secondly, what the private sector is willing to do and how these two forces can work together. This is Eskom's plan that you're looking at here. I think rather overly ambitious. But if we focus on what is really achievable, Kubrick could come back on stream during the course of this year, although I read in the news headlines that they may not be able to renew their nuclear license, nonetheless bringing 1 gig back on stream. Kusile 1, 2, and 3, where there's the chimney issue, those chimneys are being installed at the moment. Hopefully they can bring that back on by first quarter next year. That brings about 1.4 gigs of energy on. And then all we need to do is add one of the new units at Kusile or Medupi. That gets you to about just shy of 3 gigawatts of energy that Eskom can provide over the next 2 years. Importantly, this is base load, which makes it very powerful. That means Eskom could provide to South Africa a steady state, stage 2, stage 3 type of load shedding from a generation perspective into perpetuity. I know it doesn't sound great, but bear in mind this doesn't impact your key manufacturing and mining capabilities. They only get impacted when we reach a stage 6 type of load shedding, and they need to curtail their production. From a private perspective, a private sector perspective, this is the really exciting part. And if I was a complete optimist, I would say to you, 66 gigs of energy in the pipeline. But there's 2 caveats here. First of all, I would focus on the advanced stage because that is being built out at the moment and that is in the bag. So those are projects that NERSA has approved them. They've done the feasibility analysis. They have the funding for it and they've secured the land. You can see that this is a 2025-26 loaded, but it is coming on stream and that gives you about 18 to 19 gigs of energy. Second caveat here, this is renewable energy. It is not like for like with base load because the sun doesn't always shine and the wind doesn't always blow, but it is still powerful. If we bring this all together in blue, what the government can do, and bear in mind I've been very conservative here. I only have our EAF, our energy availability factor, going to 58% and then dropping to 55, 56% into perpetuity. In green, what the private sector is busy building out. Again, I've taken that and I've divided it by a load factor because this is renewable, it is not base load. And what that gives you at the bottom is in 2023, this year, we should face the worst bouts of load shedding. Gets better next year and we almost go into that perpetual stage 2, stage 3 type of load shedding from an Eskom perspective. It improves by 2025 and 2026 we start to break even. This is very powerful and this is not pie in the sky analysis. This is very conservative analysis. This means in 5 years' time we could look back to this very point and say this was a buying opportunity for us. Right now, though, it's very difficult to feel that because we're still in load shedding. Bear in mind December is a maintenance month from an Eskom perspective, so expect very severe load shedding by the end of this year. Nonetheless, we're starting to pivot into SA Inc. We might be a little bit early on the trade, but we are seeing opportunities there. So if you look here, I wanted to show you that we are active asset managers. We seek opportunities, especially in volatility. You can see how we've moved the fund around during different macro environments, both global and local. If you cast your eyes on the last two bars, how we've moved the fund from the outset of this year to currently, we've added more defense to the fund because we are concerned about the developed part of the world, the Eurozone and the UK specifically. Consumer rand hedges, we're still playing the China reopen trade. In resources, you can see the biggest move there has been our platinum reduction. We've taken that and rotated into SA Inc. We are concerned about platinum because the basket price has dropped considerably, and our understanding is that we didn't appreciate how much the OEMs would stockpile the metal, and they're starting to release that into the market. Rhodium also in the fiberglass manufacturing sector. So reduced platinum, still have a bit of a position there, but we are sitting on an underweight position because we think that the basket could go south from here. And then at the bottom there, SA Inc., we like the retailers, the banks, the insurance companies. We've gone into your higher quality names that offer you a good dividend protection and could re-rate somewhat, but they're still going to generate earnings. If the market starts to cotton on that load shedding could be something of the past and they become more constructive on SA Inc., we'll quickly rotate that into some of the laggards, some of the deeper value type of plays, and hopefully then the alpha opportunity will come through. So that's it. This is just a reminder of our performance, and this is of the equity fund, which forms part of the building block of this Fairtree BCI cautious fund. You can see that we have outperformed our benchmark by about 4.6% per annum since inception, net of all fees, and that would have been since November 2011. We continue to work hard for our clients. We want to eke out alpha for you, and we are fighting for that day in and day out and trying to seek the opportunities in this incredibly turbulent macro environment. Thank you so much for your time and enjoy the rest of the conference.
Well, thanks for clapping for that because it is a good fund indeed. The Fairtree Select BCI Cautious Fund on massive platforms, and if you look at the performance returns of the actual fund, not just the equity fund, they top quartile performance over 1 year, any time on then plus, always top quartile performance. So really good fun to look in the multi-asset low equity space. Right. Our last session for the day, I know it's getting to be a very long day, but probably one of my more exciting topics, or very exciting for me, is multi-asset high equity. And this is where all these things come together in terms of fixed income, equity, onshore, offshore. And coming to the stage now is Adrian Clayton from Northstar Asset Management and Roger Williams, who all know very familiar with from Centaur Asset Management. Adrian, you first, if you want to come up first and you can start presenting. And as soon as you're done, then Roger can come up as well, and we'll take some questions afterwards. Adrian, thank you so much.
Thanks, Eugene. Good afternoon, ladies and gentlemen. Thanks to BCI, Eugene, Tanya, and to all of you for being here today. Hopefully, we will keep it relatively interesting. My discussions on the Reg 28 fund, high equity fund, and really just our positioning, how we construct the fund, hopefully give you some good market thoughts. Just quickly, our products, we have an income fund. Those of you that have seen the Northstar income funds, often in the Citywire press, has done very well. Managed fund, which we'll talk to today. Global fund, where we've also won a few awards for that. And then our equity fund. So very simple range. Offshore, we're probably one of the longest standing managers in the offshore space. We have an income fund we just launched in the last few months to kind of copycat the success we've had in the domestic equity income space. And then our global flexible fund that's done very, very well, been in Ireland for many years. And we hope to launch an equity fund when we think the conditions are better, which we don't think is the case now. All right, so a managed fund, what's it about? Really, we position this fund as a fund that's a safe pair of hands. And we do so because the advisory community that have used it and our own high net worth clients demand certain requirements of us. And they want a fund with relatively low levels of volatility. They want to see growth. They want to make sure that they can draw of it in retirement.
And most importantly, really, it's the boutiques get forced into a space where we always are at the periphery of the local savings industry, used as a small block with big managers at the center. And we think there's a space for a more consistent fund to sit at the center and take those assets away from some of those bigger managers that are just sitting there enjoying the ride. All right. So in terms of how should you position a fund, if we weren't up here and you had to do it for your clients on your own, how should you position a Reg 28 high equity fund over time? So we've done some back testing. Our quants team, we've got a lot of quants internally at Northstar, and we rely on them. We look back at a market case going back to the 1950s and then one from 1992 onwards. And effectively, if you want to be positioned in a passive product, and I know there's going to be some people screaming at me here and say, what about SA bonds? And, you know, they've been the best performing asset class in the last few years, bar the last 2 or 3 years. But long term, how should you have been positioned? You should have had about 44% in SA equity. You should have had about 40% offshore. And you should have had about 12% in alternates, mainly gold, and the balance in fixed income. And that's because South Africa's predominantly had quite a high inflation environment historically, and it's only really been the last 20 years where the back of inflation was broken globally. So that's what would have worked had you not had us sitting here trying to do it better. Now, what's interesting about that mix is it has a standard deviation of about half of the market, so call it a risk of about half the market, but yet gives you a return of almost 6 to 7% above inflation before fees. So certainly a passive strategy that could work if you had 50, 60 years to sit back and let it happen. The problem with that strategy, just before I go to the bottom slide, what I find interesting about offshore is we've looked at every single asset class and where offshore works and where it doesn't. And in the more income generating kind of products, you want to have less offshore. And in the equity, very aggressive products, you also want to have less offshore. And the reason being that South Africa has done so well, the local markets, over such a long period of time. Now, obviously, things could change going forward, but this is a historical case study. But in that balanced fund space, you find it a very good place to have offshore because it nets off some of the risk of the domestic market, particularly with rand weakness. All right, but the problem with doing it passively is you have big drawdowns, and that's what you're trying to stop. So what do you have to get right to get a Reg 28 fund working? Well, firstly, you have to have a fixed income capability, and a lot of managers have struggled to do that. Secondly, you've got to have an SA equity capability. To be honest, one thing that we've struggled with is the domestic market and the focus on resources, and we've really fixed that in the last 3 years. But South African market's difficult in the sense that resources play such a big role. They're not great businesses, a lot of them. Then offshore, you've got to have an offshore capability. And then lastly, you've got to be able to do asset allocation. So you've got to get 4 things right to get these funds to work. So in terms of a team, you need a big team to do this. Let's make sure the slide works properly. All right, well, our team, there they are. So the team, we merged with the First Avenue team early on this year, so we've got 13 analysts now. More than 50% of our team are people of color, which represents South Africa, and more than 30% of them are female. We think that's very important. First Avenue team merged under us, follow our investment process, which we'll talk to you through the presentation. But it's a big team. 5 people on global equities, 5 people on domestic equities, 3 people in fixed income. At the center of our business is a buy list. Everything we do relies on our buy list. There are 3 of them. 1 fixed income buy list, 1 local equity buy list, 1 global equity buy list. We screen 1,300 companies around the world. We only buy into 100. That buy list, that offshore buy list, has stocks on it, 100 companies, that have every single valuation is updated for us by analysts within 3 months. We never allow any valuation to get older than 3 months. So any stock, if it's Microsoft or some European stock, we never allow the valuation to get older than 3 months. What this does for us, it gives us an idea of what potential upside exists on any stock at any time. And if we know how much we think a business is worth in terms of upside, we can do that for the whole buy list. So live in our office, we can tell you, if you came to my computer screen and asked me, Adrian, what is the potential upside to the global buy list? I'll tell you right now it's 13.8% or 35%, whatever it is that day. We can do the same on our local buy list, and we do the same on fixed income. Why is that important? Because it plays a huge role in the asset allocation framework that we'll talk to you just now about.
All right, so in terms of, I don't know why it keeps on showing the old slide behind, so I'm going to go backwards and forwards, and hopefully it works. All right. Now, in terms of the buy list, what we do is we show an average discount. So this is that black line is on average what the buy list has traded at as a discount relative to what we think the stocks are worth. So put it differently, if you bought our local buy list on any one day, and all the stocks in this period, which is from March 22, went to what we think they will be worth the next day, there'll be 20% upside. But what you can see in the line around that is that that discount's actually lower at the moment than it is on average. So it tells us, that, and this thing changes all the time. I mean, it's very volatile. It can be as much as 35% potential returns. But you'll see that we're kind of neutral on domestic equities because of that. On our global buy list, equally the same thing. The buy list discount's not big enough to be feeling like you want to throw a lot of assets in equities, into equities. Now, in terms of fixed income, our fixed income team do this, and Mark, I think you will be presenting at one of the BCI talks in the next month on our global income fund. But this is our local bond, one of our local bond slides. That orange line represents where the bond market is now. So if you bought a 12-year bond in South Africa, you buy it at 12%. Now, to put that into perspective, the latest inflation print is 4.7% in South Africa. It peaked out in October 22 at 7.4 something, so inflation's been on the way down. You're getting like a 7+% real return out of those bonds if you want to go out to 12 years. If you want to buy a 6.5-year bond, you're getting a real return of 6 to 7%. So really, I mean, there's a lot of potential returns in bonds. That orange line, where we think bonds should be trading, is the blue line. So we think the whole bond curve should be lower, and that's just our base case view on bonds. That red line is the inflation link curve adjusted for inflation. And you can buy inflation linkers in South Africa, which effectively almost guarantees you that return to the point where those bonds mature of over 4% real. Now, putting that into perspective, that's the kind of return you would want from equities over time. You're getting 4 to 8% returns. That's what you get out of the equity market. You'd be very happy with that. So in a nutshell, I mentioned that the discount isn't huge on SA equity, so we kind of like, it's still offering a decent enough return, so we are exposed to SA equities. Global equity is just not beating the hurdle rate we think is appropriate, but we have about 8 or 9% in the fund of pure equity exposure globally. The fixed income part of the fund is definitely where there's action, and we're less exposed to global cash in that, just because of the relatively low returns coming out of that space. Now, what we do with all this information, considering we've got a local buy list, a global buy list, and a fixed income buy list, and we've got all the instruments valued, it gives us a chance to take all that data monthly and put it into an asset allocation framework. So we target a very specific level of risk. We call it a standard deviation, but it's a risk level. It's about 9 to 10%. And then we optimize for it. We use a computer program which we've built to tell us what mix of assets would achieve that level of risk at the highest potential return. And we do that every single month, and we rebalance our fund. So what we're effectively doing, and avoid the complexity of it, is we're taking all the work we do and putting it into an asset allocation framework. Instead of deciding that the US is going to grow by 4% and China's going to have a property meltdown, we're saying put the effort into the buy list, put your assumptions into the buy list, and let's reflect that buy list in an asset allocation framework that is done in a highly robotic fashion. So what that means for the fund currently, and I really want to point to one or two areas of this. Firstly, ironically, we're more exposed to local than we are to offshore. Local offers much higher expected returns. Now, we understand that the South African government is going to have a debt to GDP problem of 73% this year. We also understand that there's going to be a budget deficit of 6-odd%. We understand these things. We're not stupid. And I was saying to Koos, one of the people that's attending earlier on, that we also know that you go bankrupt slowly and then it happens overnight. So that's how it works in reality. So these are things we have to watch as asset managers, but we're being compensated, or our clients are being compensated at this point in time by extremely high expected returns in certain asset classes in South Africa. And, we have the benefit at this point, because there's no serious exchange controls in asset managers, on exposing ourselves to offshore assets very quickly if we need to. But the returns on purely return basis do not justify us owning more than we own currently offshore. And we've actually brought assets back on offshore on these high rand levels over time. The other point I want to make is that everyone's talking about debt in South Africa. Our problem is not debt, it's growth. In 2015, the South African economy grew by 1.1 trillion rand in a quarter. It exceeded that growth rate in 2018, subsequently dropped in COVID, and it's only just gone back above that now. So we still only make 1.1 trillion rands a quarter, all those years later. So we need to release growth in the system. I've got a few minutes left. What we can do with our asset allocation framework is we can target what risk we want to take. If we think the market's cheap, and it's telling us through our buy list that it's cheap, we can aggressively push the risk up in the fund. So what we show here is that the fund is tended in blue to operate at a lower risk level than peers over time. There are many reasons for that, but our framework now allows us to up that risk whenever we want to. So at times, we push that risk level up to where the peers are. If the markets are expensive, we pull it right back. When we think it's cheap, we push it straight up. And our business, which is 12 years old, has got such a powerful framework in it now that it allows us to do this at will. Now, this is an interesting graph. It shows a whole lot of different peers, and it's something called a tracking error. And a tracking error is just purely the risk that managers take. And those big peaks that you see there are managers that have taken excessive risk on their pricing but have not necessarily paid clients back in terms of returns. Our tracking error is in red, and we're just saying we run quite a low tracking error fund. So we give a lot of returns for the amount of risk we're willing to take. And that's reflected in really one of the last slides here, is the Northstar Managed Fund sits to the left of the peer group on a risk spectrum, but it sits above the peer group in terms of returns. And really, we've learned a lot of lessons over almost 30 years that I've done this. And one thing I can tell you, I've never worked for a business with a better process and framework that allows us to actually do better in the years ahead than we've done in the years past. My last few slides is really just to sum up. You got to get SA equity right. We do that now. You got to get global equity right, and we've done that for years and won a few awards. You got to get fixed income right. We do that too. And our asset allocation framework is a sound one that we know will benefit clients over time. And that's generated excellent long-term returns for clients. Thank you very much.
Thanks, Adrian. Roger? Ready? Yeah? Yeah, you can. Thanks.
Show this off. Okay, that's off. Why do I always get the last birth? Thank you very much. My name's Roger Williams. I'm going to present on my balance fund. Just a quick update on Centaur. Centaur's been operating almost 23 years and was founded in 2000 with 3 guiding principles: to deliver investment excellence with outstanding service and the utmost integrity. And this is the culture of Centaur. We are focused on delivering exceptional returns for our clients, and we'll show you our relative performance, and I think we're doing that. And if we meet the other 2 in addition to the first, I think we'll be one of the best asset managers in South Africa. So this is the objective, and everyone in the company is focused on meeting these principles. We're a retail-only asset manager. We don't have institutional funds. And the reason why is we want flexibility and focus our stocks picking skills on a smaller pool of assets, so we can continue to perpetuate alpha as we get bigger. We've got a tightly knit team with bonus pools and select members getting profit share. And also we're launching an equity fund in November. Just looking at our returns. So this is since inception on the 1st of October 2000. an 18.4% return, outperforming our benchmark by almost 7% per annum. And if you look at below the graph, our early clients are up almost 50 times. But what stands out is consistent alpha generation on after fees. And this is really what we're trying to deliver. By investing in Centaur, you earn excess returns. We've done it in the past, and we're looking to perpetuate that in the future. Just our philosophy is very, very important. And this really guides the whole investment team when we're looking at opportunities and whether we should hold or sell, buy or sell. And we classify it as dynamic value creation. So this is really where a company over time needs to grow, it needs to spin off dividends and grow as an entity and evolve. And particularly important is management. We look for exceptional individuals who have displayed in the past an ability to create value. So, for example, RMB Holdings has been an incredible success, spawning both FirstRand, Discovery, and Outsurance, and really incredible value creators. Remgro is another example, also spinning off Richmond and Renit as enormous companies in South Africa. So just to give you an example how we have deployed this into our process is a company called Fiat Chrysler Automobiles. We invested in it in October 2014. And everyone really knows, consensus view is autos are a very bad industry. But we found a couple reasons to invest. First of all, we identified exceptional value creators in the CEO and chairman, and they really have delivered. And also a hidden asset in Ferrari. So what we find when you find good management, they'll do the right things for shareholders. And they did unbundle Ferrari in January 2016. That was a massive value unlock, and Ferrari has been an incredible success, up 7 times since then. In 2019, they sold their parts business and paid a special dividend. And also they realized early on that Fiat was very poorly positioned. They needed critical mass. So actually in 2009, they bought a Chrysler out of bankruptcy for virtually zero consideration. And through a series of transactions, got 100% control. And that business, which they paid virtually nothing, earns $14 billion of operating profit last year. So through very shrewd management actions, they've created immense value for shareholders. And we've got on board by identifying these characteristics early on. Just how it ends off, Fiat Chrysler realized they didn't have the critical mass to go into all the technology to go into the electric vehicle era. So they engineered a further merger with Peugeot to form the 4th largest auto company called Stellantis. And they're actually at the forefront of electrical vehicle technology. So taking a very bad hand 15 years ago, through very clever transactions, position the company well to go into the future and be one of the leaders. And really, that's how a company evolves over time. It's not the same, and that's what we're looking for. Just looking at markets, one of the things we're really concerned about is the yield curve inversion in the USA. So the last 6 recessions have actually been predated by an inverted yield curve. And the yield curve in the US is extremely inverted. So we're just saying warning lights are flashing and one needs to be wary. One may ask the question, why haven't these higher interest rates up over 5% off the low point impacted the economy yet? I think a lot of the debt in the US has been fixed. So I saw an article just this week about housing prices, and housing prices in the US you would expect with higher bond rates would come down. Instead, they're going up. And what they found is a lot of homeowners have very low fixed rate debt. So they're actually not selling their house, because if they sell their house, they'll lose that benefit. So there's actually a shortage of supply, and housing prices are perversely moving up. But I think a lot of these impacts are just temporary and will come through in time. So we're wary of offshore and going underweight. Just to give you an idea, actually when they drop interest rates, that's the time to be concerned, because that means they've braked the economy too much. It's like slowing down a super tanker. You brake it now, the impact only affects 6 months, 9 months, a year. And we think it's going to be very hard for them to engineer a soft landing. So we just think it's time to be cautious on overseas. You've done exceptionally well. Take some profits. Cash is yielding you about 5% in US dollars. be cautious, the opportunity will come. Just the SA outlook, we're seeing some structural improvements happening. So a lot of the news in the press is actually slightly more biased to the positive, and this is really a change. I think it's a real change. To give you some example, just in the last month, I think very importantly, Transnet signed a private-public partnership for the Durban port, and this is really what we need. We need greater efficiency in Transnet. There's more urgency to get locomotives. As we heard in a previous presentation, Eskom power crisis may abate. Maybe we're only going to level 2, 3 instead of level 6. That will be positive. So we see a lot of positive signs, and I think this also goes, the government's starting to run out of money and really has to embrace the private sector to get some of these initiatives off the ground. Also, we see fixed investment picking up, particularly in roads, water and renewable projects. And for example, Wilson Bailey has a record order book. So that's saying there is actually business out there. So over the last 6 years, economic growth has been 0.5% per annum. We think it's going to improve over the next 5 years. This is positive for equities. We're not wildly bullish. Maybe growth will be 1 to 2%, maybe 1.5%, but it is an inflection point, and we think that's positive. Within our balance fund, we have been selectively buying in South Africa. We see some good management changes, some good businesses. So, for example, we've bought Altron, Roynet, and Kura, and these already are contributing nicely to performance. Just a word of caution, we found during tight interest rate cycles, which we define as when interest rates rise 1.5% off the bottom, this actually suppresses equity returns, and when interest rates drop from the peak, that turbocharges equity returns. So tactically, we actually underweight, really due to the signal. It's been very powerful in the past. And also, we're earning between 9 and 10% on cash at the moment. So it's not, the opportunity cost of not being in equities is not high. So actually, tactically, we're underweight. You can see that in our asset allocation. So on fixed income, we are 8% overweight relative to benchmark. And we also, if you look on the offshore cash, we've got a very large offshore cash holding, 9%. If we write on the US market and there is a big drawdown, the rand will weaken, and that is a very good hedge at this time. Also, we're earning about 5% on that. If we take off the offshore cash, the local fixed interest portfolio is earning over 10.5% running yield. So very attractive yields on offer whilst we're waiting for cycles to turn. Locally, JSE equity, we're about 10% underweight. We have been buying, but having said that, we're also finding things to sell, but we have been nibbling and more on the buy side. What we do is we look for internal rates of return. So if there's excess returns to be had, we'll actually deploy cash into equities opportunistically. World equities, we have pared it back, but we're slightly overweight. But one must realize we substitute some local equity exposure for offshore equity exposure. So, for example, we don't have any Naspers. We'll take exposure from direct world equity exposure. So this really sums up the investment strategy. I'm not going to go into it further because I've really covered it. I think we are going to remit rands back to South Africa on rand weakness. So if there's a fall, let's say the rand hits 22, we can bring money back, lock that in, invest locally. Also resources, we've been underweight. We have been nibbling at resources. They're showing good value, but we can't see the catalyst. So even though we're underweight, we've been nibbling and neutralizing our underweight position there. Just looking at performance of the underlying segments of the portfolio, fixed interest, a marginal underperformance over the last 5 years, but that's purely due to property. Property has been a very weak sector over the last 5 years. So if we take out property, we've delivered an alpha of 0.5% on the fixed interest portion. Local equities, our alpha generation is almost 3%, and global equities just a marginal outperformance. But having said that, the world index has been a very strong performer, and just to match the world index, and we had very little tech exposure, we're actually happy with that. We think that's a good outcome. Our asset allocation alpha has been about 1% per annum. That's primarily being overweight offshore, which has been the best performing asset class. So about 1% per annum asset allocation alpha. Just looking at some of our bigger holdings, I think what differentiates us, we mainly stock pickers, we're not index huggers, and a lot of our holdings won't be held in competitors. So it actually provides a very nice diversification if you invest in the Centaur Balance Fund. Aspen's our largest. What we like there, we found a super entrepreneur in Stephen Sard. He's created a base, a global base. It's 75% outside of South Africa, so it's a global multinational. And he's got a distribution hub, he's got a manufacturing hub, and what he's doing, he's adding more load on this through distribution agreements, manufacturing agreements. Just in the last 6 weeks, he's announced 6 new contracts, and this is going to contribute over the next 2 years. So this is going to push strong growth, and we look at internal rates of return over 20%. ABSA, a lot of positive changes post Barclays. We think it's a better company fundamentally, but trading at 1x book. Also returns of about 20% per annum to be had. And Truworths, which has performed exceptionally well in a difficult industry, very, very good management, very high returns on equity, and they've got a hidden asset in the UK, their office subsidiary, and that's been performing exceptionally. So as that unwinds, we still see good growth from Truworths. Just looking offshore, Exor is the holding company of Stellantis and Ferrari. Exceptional value creation by management over a very long-term track record. So this is a holding company, and it's delivered returns of 17% per annum in euros over the last decade, outperforming the MSCI World Index by 6% per annum. You would have thought because of this exceptional performance it would be trading at a premium, but it's trading at a 45% discount. So happy for it to be one of our largest holdings. It is diversified. Dell's come through exceptionally well, also led by a super entrepreneur, Michael Dell, who formed it from his dorm room when he was at university, the largest hardware seller in the world, and its business model direct to the consumer is continuing to take market share and very strong competitive advantage. So this is actually doing well because it's very well placed for artificial intelligence. They're setting a lot of their high-end servers for artificial intelligence. And then Flutter, also another different one. That's the world's largest online sports betting company and online gambling company. It's the market leader in the US. If you know that industry, it's opening up on a state-by-state basis, and and growing very, very rapidly. We think the industry will still grow another 3 times over the next 8 years. And as this growth unwinds, going to lead to very strong returns from Flutter. So another differentiated company we are positive in. So you can see our expected returns in dollars or hard currency, Exor 20%, Dell 15%, and Flutter 20% odd. Just looking at performance. So this is our A class. It's the retail class in red. I think the most important thing, you listen to us, is really how much money we're going to make you. And I think it's relative performance and absolute performance. You can see over 3 years, 13%, 5 years, 9%, and 10 years, 10%. Bear in mind, you as advisors get a discounted class, so you can add an extra 0.6% onto these returns to get the B class returns, what you would invest in. And we're very happy. Over 10 years now, we've got a 10-year track record, number 2 out of 82. So it's showing our process works. We're good asset allocators, we're good stock pickers, and combining it all is leading to very strong relative returns. You can employ this by adding a portion of the balance fund into your portfolios, and that should lead to better returns. We've tested it. I'm not going to go into the depth of this, but you can add incremental returns by including the Centaur Balance Fund in your mix of balance funds. So just concluding, we're off to a very good start. I think we're proactive on our strategy. We're sticking to our guns. We see some opportunities. We are cautious. We're ready to change course when conditions change. And we're having a very strong outperformance here, but we think we're well placed to continue. Thank you very much. That concludes my presentation.
Thank you, Roger. Any questions for Roger and Adrian? Yeah. Right, exactly. Maybe just quickly, I mean, Ian and I had a discussion earlier on, and it almost sums up all the discussions we had all day. Bond yields, extremely attractive. SA looking 12 and a half. Not risk-free, we all know that. But if you look at some of the equity numbers coming through and what you could potentially earn equities, Roger, you also mentioned that you're a little bit more cautious at the moment, looking for the right times to buy back into the market. Some more positive than others on SA equity, maybe less so on global equity. I think what a lot of us are battling with is that continuous debate between, if bonds offer you these very attractive yields, why not hold more SA bonds relative to SA equity? And if we are scared of a very strong dollar, or dollar that's perhaps too strong, yes, you could say stronger for longer, why not hold a lot less global equity at this stage? Roger, I don't know if you maybe want to go with that first, and Adrian, you can comment on that as well.
So, I've considered bonds. Often when something's cheap, you must first reverse and say, why is it cheap? Because everyone knows the yields. Think it as an individual. Would you lend the current regime money? I mean, really, that's what we're doing. I mean, I don't know. I don't know if I would. I mean, to be honest, so I've toyed with this question. I'm just saying this, I don't really trust it, because unless they make massive changes, I can't say to my clients, I'm going overweight. I can't go, I'm going all in on bonds, because we know the risks. And we see problems, but we're not seeing enough changes. So I think that's the short answer on bonds. And global equities, it's not a homogeneous basket. So there's great companies which are going to grow. And so to be out, first of all, the thesis could be wrong. Maybe there is no recession, so one has to be cognizant of that. But secondly, we stock pickers, so we still, let's say Flutter, we see it growing at, 20% per annum for a couple of years, and we think it's a secular growth industry. So why get, just because we're worried, we're going to retain that. Maybe we're keeping some powder to take care of opportunities. So that's why you have to be very careful about taking these extreme views. You could be wrong and they get blown out the water.
And we've seen that a couple of times this year. Not necessarily you, but I mean, all the forecasting models all being very off.
Yeah, I mean, I agree with Roger. I don't think you can go into the bond space in South Africa blindly. And I did speak about South Africa's kind of fiscal issues. But it's also around duration and what duration you're willing to take. I mean, you can calculate at the rate at which governments are deploying or destroying capital, how long it will take for them to be in serious trouble. So, if you're taking shorter duration and you're getting high yields on it, as long as you're being compensated, but I certainly wouldn't suggest someone goes and buys 30-year paper. I don't think most of us in the room will be around to see that, to see you get your money back. So, that's one point, what duration you're willing to take and the returns you're getting for it. And on the global side, look, I mean, more than 50% of Japanese stocks are net cash positive. There are buybacks in Japan. Europe's trading on a multiple of 10 despite slowness in the economy there. You've got the US on a forward of 19, but if you take 3 steps back, you get some stocks on P's of below 10, believe it or not. So you've got to know what you're doing. You've got to have the screening systems in place and the humans in your business to find those opportunities. So I agree, it's not homogenous. And I think, if I can make one point, I think the last few years was fertile ground for index trackers. And I think the next few years is going to be fertile ground for active. And I know that's a big debate in its own right, but the opportunities are really there, to take advantage of some of the stocks in the market.
Yeah. Adrian and Roger, thank you so much for being here today. It's really always great to have you here. I know it was a very last session of the day, but you've done a very good job, and with managing your funds as well. Thank you so much.
Thank you.
Right, just on closing off very quickly, to all our presenters today, not only Adrian and Roger, thank you for the phenomenal work you've done, great presentations. To the BCI team, Tanya and Olga, putting everything together. You don't see Olga here today, but she runs all the mechanics at the back always for us. The multimedia team, thank you for running stuff smoothly here. Tanya asked me to remind you, for those of you who've got parking tickets, not fines from Metro for parking here. If you want some of that, you must go to the hotel reception desk. They will give you validated parking tickets there. And to our marketing team, thank you very much. Quick reminder, 13th September, we've got our Global Manager webinar again at 11:30, and we hope to see you there. To all of you being here today, we're very grateful for your continued support. It's all about you. Thank you very much. Thanks, Jeets.